once again in the live virtual revisionary class organized by Board of Studies of ICAI. Students, today we are going to discuss two standards, Ind AS 16 and Ind AS 23. So first, let's begin the journey with Ind AS 16. The name of Ind AS 16 is Property, Plant and Equipment. Friends, this is an asset-based standard and this is very important standard, I must say. And if you revise this standard in a beautiful manner, you will be able to revise 50% of Ind AS 38 intangible asset and almost 50% of investment property, and I would say a 10% of Ind AS 116 also. So this standard very important standard from the perspective of application in the exam as well as application in the real and the practical life. Okay, so friends, let me take you through the concepts of Ind AS 16 quickly in the next 15 minutes. Then we will do some questions on Ind AS 16, right? So friends, here we will be talking about the 4 principles of accounting, which is RMPD. In this Ind AS 116, we are going to cover the recognition. We are going to cover the recognition, measurement, presentation, and disclosure. When I say recognition, we are going to cover about the initial recognition and subsequent recognition, right? When I say initial recognition, means if a machine has been purchased, then how this machine is going to be recognized. Is it recognized as an asset, I mean to say as a property, plant and equipment, or is it recognized in the P&L, or how it is going to be recognized, right? So this standard talks about initial recognition. Subsequent cost. You have incurred a major expenditure on the machine after 5 years, or you have incurred a major inspection cost on the machine after 2 years, or you have incurred a major overhauling expense on the machine after 3 years, right? So how this major inspection, major overhauling, major replacement is going to be accounted for, right? Which is subsequent cost. Then we'll speak about measurement at recognition, right? So at the time of recognition, how this PP is going to be measured, right? What are the element of the cost? Then we'll talk about measurement after recognition, means measurement at initial recognition, measurement after recognition, right? At the reporting date. So there are cost model, there is revaluation model. We'll also talk about depreciation, depreciable amount, depreciation period, depreciation method, okay? Then impairment and compensation of impairment. And at the last, there is a derecognition criteria. There is a derecognition criteria and the disclosure, right? The presentation is given in Ind AS 1, which says that property, plant and equipment is the one of the minimum line item on the face of the balance sheet, and it is the first line item on the face of the balance sheet as per Schedule 3. Let's quickly get into this Ind AS 16, okay? Objective is to provide the accounting for Ind AS 16 PPE, to provide the accounting for property, plant and equipment, which includes recognition, measurement, presentation, disclosure. Ind AS 16 is applicable to all PP except negative list is given. PP classified as held for sale, biological asset related to agricultural activity, recognition and measurement of exploration and evaluation assets, mineral right and mineral reserves such as oil, natural gas and similar non-regenerative resources. So this list is given for the scope paragraph. You can just read that. Definition of PP is very important, friends. Tangible item. PP is a tangible item which is held for use in production or supply or rental purposes or administrative purposes and expected to be used during more than 1 year, more than 1 period. Friends, PP is something which is a tangible item like building, like furniture, like office equipment, right? Like vehicle, like aircraft. So PP is a tangible item which is held for use in the production of goods or supply of goods and services, or for rental purposes or for administrative purposes, which is expected to be used during more than 1 period. Now let's have a question. So a company has purchased a building, a company has acquired a building, and company has given that building on a rental basis. Company has given that building on rent. A company has purchased a building for the purpose of earning a rent from that building. Now the question is whether this building is going to be, whether this building is going to be capitalized as a property, plant and equipment, or this building is going to be capitalized as some other asset. Tell me. So friends, this building which is held on a rental basis or land which is held on a rental basis means land which is kept for a rental earning, and building which is kept for earning rental, they will be classified as an investment property. They will not be the PPE. So what is the exception? What is the exception? Exception is exception is land and building kept to earn rental will be investment property, will not be PP, it will be investment property. But the company has acquired a printer and the company is giving this printer on a rental basis. So those printer will be capitalized as a PP in the books of the company. Okay. Those printer will be capitalized as a PP in the books of the company. Right? Clear? Okay, great. So friends, this is the definition of PPE. In the definition of PPE, the important part is this PPE, the exception is the investment property only in the PPE. That's the only exception, right? That's the only exception in the PPE. Okay. Yes. Now let's move on. Let's move on, my dear friends. So this is a small example which we have covered. Recognition criteria, two recognition criteria means the any item, right? Any item of an asset or any item will be classified or recognized as a PPE, right? Any cost spent by the company will be recognized as a PPE if it is probable that future economic benefit will flow to the entity, if that asset, if that item will give the future economic benefit to the entity and cost can be measured reliably. Am I audible, Ashok ji? Yes. Yes. So friends, an item, an item of an expense or an item or a amount which is spent will be recognized as a PPE. Any cost which is incurred will be recognized as a PPE if it is probable that future economic benefit will flow to the entity and cost can be measured reliably, right? If there is a spare part, standby equipment and servicing equipment, so those will also be recognized as PPE if it met the criteria of PPE, if it is a tangible item held for production or supply of goods and services, held for rental or administrative purposes, and it is used for more than 1 year, right? The life is more than 1 year, and it is meeting the recognition criteria of PPE, which means it is probable that future economic benefit will flow to the entity and cost can be measured reliably. Otherwise, these spare parts, standby equipment, and service equipment will be classified as inventory. Okay. Subsequent cost, my dear friends, subsequent cost, for example, major inspection, overhauls, right, in the form of major replacement cost, major inspection, overhauls, these are classified as a property, plant and equipment. Means if a company is incurring a major cost, that will be capitalized as a PPE, right, and depreciated subsequently. So major cost in terms of inspection, overhaul and replacement will also be capitalized, will also be recognized as a part of PPE if it is meeting the criteria, if it is meeting the initial recognition criteria. So the same criteria is followed as of initial recognition for subsequent cost also, added in the carrying amount of PPE if recognition criteria is met. For example, there is a truck, right? So truck has to be capitalized as PPE. It has to be recognized as PPE because it is probable that future economic benefit will flow to the entity. Truck will provide the transportation services of the goods. Truck will transport the goods from one place to another. Number two, cost can be measured reliably. Cost can be measured reliably, right? So if you have purchased the truck, you know the cost of the truck as well, right? So friends, same criteria followed as of initial recognition, added in the carrying amount of pp if recognition criteria is met, right? So that the truck after 6 years met with an accident, and in the accident major costs incurred, the engine was replaced in the truck, and the cost of the engine was significant, so that engine is going to be capitalized and depreciated over the remaining life of the truck, right? Because if the engine will not be replaced, the truck will not be able to run. So it is probable that future economic benefit will flow to the entity, and of course cost is known, right? So for the subsequent cost, same criteria needs to be followed as of initial recognition, and it has to be added in the carrying amount of PPE if recognition criteria is met. Day-to-day servicing cost, which includes labor and consumable, needs to be expensed off, right? So this is we discussed. Now this one question which talks about the concept of replacement cost, major replacement cost, subsequent cost. So friends, let's come to the word file and discuss one question on Index 16. Okay, the same question is there in the word file also. MS Limited. I hope this word file is visible to everyone. Yes. MS Limited has acquired a heavy machinery at a cost. This is the example of subsequent cost. MS Limited has acquired a heavy machinery at a cost of 1 crore rupees with no breakdown of the component parts. The estimated useful life is 10 years. So they have acquired a machinery, cost of machinery is 1 crore. What is the accounting entry? Since it is a machinery, it will provide future economic benefit and cost can also be measured reliably. So what is the accounting entry? Machine account debit to bank account. Machine account debit to bank account. Machine account debit to bank account. Okay. It is machine account debit to bank account, right? Machine account debit to bank account. Okay, friends. So now this company has acquired a machinery, and this machinery will be capitalized as a PPE for 1 crore, machine to bank. Useful life is 10 years. So what is the per annum depreciation? Assuming the residual value is zero, what is the per annum depreciation? 10 lakh rupee. At the end of 6th year, one of the major component, the turbine require replacement. So one of the major component of this machine, turbine require replacement, as further maintenance is uneconomical. The remainder of the machine is perfect and is expected to last for the next 4 years. The remainder of the machine is perfect and is expected to last for the next 4 years. The cost of a new turbine is 45 lakh. Discount rate is 5%. Friends, so this machine life was 10 years. At the end of the 6th year, means this machine was running fine for 6 years, but at the end of 6 year, this machine was undergo with a damage, and the turbine require replacement. So one of the major component, turbine, requires a replacement. Why? Because the further maintenance is uneconomical. The remainder of the machine is perfect and is expected to last for the next 4 years, right? The cost of the new turbine is 45 lakh. So the cost, what is the replacement cost? 45 lakh. And discount rate is also given in this question. Analyze whether the cost of new turbine can be recognized as an asset, and if yes, then apply the accounting treatment relevant to it. First of all, initial recognition. So machine has to be capitalized as a PPE. Machine has to be initially recognized as PPE. Now, what about after 6 years? What about this major replacement cost? This major replacement cost, you need to check the recognition criteria, same recognition criteria of initial recognition, whether future economic benefit is probable and cost can be measured reliably. Yes. Answer is yes. If this turbine will not be replaced, the machine will not be run for the next 4 years. The machine will not be able to give the future economic benefit for the next 4 years, right? But tell me one question. For example, if this is a machine, right? This is a machine. This is a machine. And in this machine, turbine is already there. In this machine, turbine is part of that machine. When this machine was purchased at 1 crore rupee, this turbine was included in the machine, but the value was not known, right? Because the breakdown of component parts were not there. But now this turbine got replaced. Now this turbine got replaced. So original turbine was there. Now one more turbine was getting added. Are you getting me? So in the books of accounts, this 1 crore which was capitalized as a gross block, right? Which was capitalized as a gross block, the machine and the turbine which was already capitalized. So means turbine and the other part of the machine was already capitalized. So now when you replace the turbine and when you add this new turbine into the cost of the machine, don't you think two turbines got added in the cost of the machine in the books of accounts? Answer is yes. While practically you will remove that turbine and add the new turbine, the new component, but in the books of accounts, same two components are added in the cost of the machine. Okay. Now, my dear friends, the question is, first question is clear. This 45 lakh rupee of new turbine is going to be added in the cost of the machine. That is number one. Number two, since at the inception, at the original recognition, the breakdown was not given, this 1 crore has to be capitalized as a machine. And every year 10 lakh rupee has been depreciated. And the gross block is 1 crore. Accumulated depreciation at the end of the 6 year is 60 lakh. So net block is 40 lakh. So company knows the net block 40 lakh rupee only. 1 crore gross block, 60 lakh accumulated depreciation, 40 lakh net block. Now, this 45 lakh has to be added to the 40 lakh rupee of net block. Okay, this 45 lakh has to be added. So 1 crore is my what? 1 crore is my gross block, right? So gross block is machine. Gross block, accumulated depreciation net block. 1 CR, 60 lakh, 40 lakh. Okay. Now, friends, at the end of the 6th year, it is very much clear that you will add a new turbine. You will add a new turbine for 45 lakh. But how you will de-recognize the old turbine from the books of accounts? Because you are not aware about the cost of the old turbine. Friends, standard says that if you will add a component into the cost of the asset, the old component needs to be replaced, the old component needs to be derecognized. Now, how the old component will be derecognized? Standard says that if the breakup of the cost of the old component is not there, is not known, then you have to use the cost of the new component as a surrogated cost to arrive at the original cost of the old component. So what is the cost of the new component? 45 lakh. So 45 lakh cost as of today. 45 lakh cost is cost as of today. If I need to find out what was the present value of this 45 lakh 6 years before, what was the present value of this 45 lakh 6 years before, how will I find out? I will discount it. I will discount it using this discount rate of 5%. So present value of turbine 6 years back using the replacement cost, right? Using the current replacement cost. So current cost is 45 lakh. If I divide this 45 lakh divide by 1 plus discount rate to the power 6, it will give me 33 lakh 57,900. So I got the cost of the old turbine. Now, if I know the cost of the old turbine, what should I do? I should I should compute what is the net block of the old turbine. What is the net block of the old turbine? How I will compute the net block of the old turbine? कैसे कंप्यूट करें नेट ब्लॉक ऑफ द ओल्ड टरबाइन को? कैसे कंप्यूट करें बताइए? कैसे कंप्यूट करूं नेट ब्लॉक ऑफ द ओल्ड टरबाइन को? प्लीज टेल मी, हाउ कैन आई कंप्यूट द नेट ब्लॉक ऑफ द ओल्ड टरबाइन माय डियर फ्रेंड्स? कैसे कंप्यूट करेंगे? So simple. If 33 lakhs 57,900, so now I need to break this gross block, accumulated depreciation and net block. So turbine and machine other than turbine. Okay. If 33 lakh 57,000, if 33 lakh 57,900, 33, sorry, 33,57,900, this is the cost of turbine. Then what is the cost of other than turbine? 100, 3358, 3358, 3360, 3360, then 34 lakh, 34 lakh, okay, then 66 lakh. 66 lakh 42,100 is the cost of other than turbine, right? Then 10% is the rate of depreciation. Every year there was a 10% depreciation. The life was 10 year. So what is the accumulated depreciation for 6 year? So 3,35,790 per year into 6. 6,64,210 multiplied by 6. This total will come at 60 lakh rupee. This total will come at 1 crore rupee, right? And this total will come at 40 lakh rupee. 40 lakh rupee. This total will come at 40 lakh rupee, right? Right? So friend, this is how I will get the net block of the turbine. When I get the net block of the turbine, I will depreciate it. Okay. So the current carrying amount of the turbine and what is the, right? So friends, the new turbine will produce economic benefit to the MS Limited and the cost is measurable. Hence, the item should be recognized as an asset. The original invoice of the machine did not specify the cost of the turbine. However, the cost of the replacement 45 lakh can be used as an indication, usually by discounting of the likely cost 6 years back. If an appropriate discount rate is 5% per annum, 45 lakh discounted back to 6 years amounting to 33,57,900. Now the current carrying amount of the turbine, which is required to be replaced, of 1343,160, the current carrying cost of the current carrying amount of the turbine which is required to be replaced of 1343,160. How this 1343,160 has come? How this 1343,160 has come? Let me show you. Let me show you. What is your value of the turbine? 33, sorry, 33, 57, 33, 57, 900. 33, 57, 900. This is the gross block of the turbine. This is GB of turbine, right? GB of turbine. Okay. This is my gross block of the turbine. Now, what is my egg depth for 6 years? Egg depth for 6 years. My egg depth for 6 years is this, divided by 10 because 10 year was the useful life initially, multiply by 6. Right? What is my net block? What is my net block of turbine? My net block of turbine is this minus this. 1343,160. Friends, this 1343,160 is going to be, this 1343,160 is going to be de-recognized and 45 lakh is going to be recognized. So the current carrying amount of the turbine which is required to be replaced of 1343,160 would be de-recognized from the books of accounts. Original cost is this much as reduced by accumulated depreciation for past 6 years. Assuming depreciation is charged on a straight line basis, the cost of new turbine 45 lakh would be added to the cost of machine, resulting in a revision of current carrying amount of the machine to 71 lakh 56,840. How it has arrived? 40 lakh was the net block. In the net block, 1343,160 pertains to turbine and 45 lakh pertains to a new turbine, right? So this will be your new carrying amount. Original cost of the machine 1 crore reduced by accumulated depreciation till the end of 6 year is 60 lakh rupee, right? This is what we have seen. Okay. So friends, this was your this was your treatment of subsequent cost, right? This was your treatment of subsequent cost and derecognition of the original component of that asset. Okay. Now, my dear friends, talking about the measurement at initial recognition, initially asset has to be measured at cost. And what is the definition of the cost? Purchase price, including import duties and non-refundable taxes, minus trade discount and rebates. Okay. Then directly attributable cost. What is meant by directly attributable cost? Incremental cost of acquiring an asset. So had this cost not been incurred if the asset would not have been purchased, अगर ये एसेट परचेज नहीं होता तो एसेट की तो ये कॉस्ट भी नहीं आती. फॉर एग्जाम्पल, what is the example of directly attributable cost? Installation cost. If the machine would not have been acquired, installation cost would not have been incurred. Installation cost would not have been incurred, right? So directly attributable cost means incremental cost. Directly attributable cost means had this cost not been there, had the asset not been acquired. Okay. Freight cost, transportation cost, carriage cost. You imported a machine from China. So all those transportation costs, right, carriage inward, all those costs will be considered as a directly attributable cost. Plus initial estimate of the cost of dismantling and removing the item and restoring, right? So plus provision for decommissioning and site restoration cost. Do you remember we discussed this cost in Ind AS 116 also, right? Provision for site restoration and obligation. Okay. So these are the three costs which is going to be part of the element of the cost at the time of initial recognition, at the time of initial recognition. Is that clear, my dear friends? I hope it is clear to all of you. Yes or no? Yes. So what is directly attributable cost? Cost directly related to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management. These are the example of the directly attributable cost. Employee benefit cost arising directly from construction or acquisition of PP. Installation cost, site preparation cost, assembly cost, professional fee, initially delivery and handling cost, testing cost, right? Cost of testing. Whether the asset is working properly after deducting proceeds from sale of any product produced during the testing period. What are not the examples of directly attributable cost? Cost of conducting business in a new location or with a new class of customer, including staff training, right? If the company is doing a business in a new location, so the cost of conducting that business in a new location, those that will not be capitalized. Or if the company has moved its plant from India to China, the company is giving a training of Chinese language to all the employees, so that will not be considered as a directly attributable cost. Cost incurred in introduction of a new product or service or opening a new facility. The company has invited Mr. Amitabh Bachchan to inaugurate the factory or to launch a product or advertisement cost. This will not be administrative and other general overhead will not be considered as a directly attributable cost. Or abnormal costs are not will be abnormal costs are not considered as a cost of PPME, right? Those costs needs to be expensed off. Decommissioning cost we know, right? Now friends, let's have a question on the cost part. I hope my Word file is visible to everyone. Just a minute. Yes. X Limited started construction on a building for its own use on 1st April 2010. The following costs are incurred. Purchase price of land 30 lakh rupee. So this company is constructing a building. Okay. So this land cost is there. Whether this land cost will be capitalized? Answer is yes. Stamp duty and legal fee 2 lakh rupee. Whether the stamp duty and legal fee is going to be capitalized, right? Stamp duty and legal fee is going to be capitalized. This is cost of PPA. Whether this stamp duty and legal fee, it is going to be capitalized. Yes, it is a directly attributable cost. Architect fee, 2 lakh rupee. Whether it is going to be capitalized. Yes, it is a directly attributable cost. Okay. Site preparation 50,000. Yes, it is a directly attributable cost. Material 10 lakh rupee. Yes, it is a directly attributable cost. Direct labor cost, directly attributable cost. General overhead, we discussed. Administration and general overhead is not part of the directly attributable cost. Other relevant information. Now, let's come to the other information also. Material costing 1 lakh rupee have been spoiled and therefore wasted. Material costing 1 lakh rupee had been spoiled and therefore vested, and a further 1,50,000 was spent on account of faulty design work. On account of faulty design work. Friends, so 1 lakh rupee of the material has been spoiled and vested, spoiled and therefore vested, and a further 1.5 lakh was spent on account of faulty design work. On account of faulty design work. So what does it mean? First of all, there is an abnormal cost. There is an abnormal cost, right? What is my total cost of the material? My total cost of the material is 10 lakh rupee. Out of 10 lakh rupee, 1 lakh rupee have been spoiled. 1 lakh rupee have been spoiled. Okay. So that is there, 1 lakh rupee have been spoiled, and 1.5 lakh was spent on account of faulty design work. Means 1 lakh rupee material was wasted. So that is the abnormal cost that you will reduce. You will not capitalize in the cost of PP&E. And 1.5 lakh was also spent on the faulty design work, which is of no use, right? So there is an abnormal loss of 1.5 lakh also. So what we will do, 10 lakh minus 10 lakh is the material cost. 10 lakh minus 1 minus 1.5 lakh, right? 10 lakh minus 2.5 lakh, we will reduce from the cost of the material for the purpose of capitalization. As a result of these problem, work on the building was stopped for 2 weeks during November 10, and it is estimated that 22,000 of the labor cost relate to that period. 22,000 of the labor cost relates to that period. Friends, what is my direct labor cost? My direct labor cost is 4 lakh rupee. Okay. My direct labor cost is 4 lakh rupee, but 22,000 belongs to that period where the work was stopped, means it is again an abnormal loss. So this 4 lakh rupee minus 22,000. So 22,000 rupee has to be excluded from the scope of capitalization, right? It will not be considered as a directly attributable cost. This abnormal loss, this abnormal cost is going to be excluded from the cost of capitalization. The building was completed on 1st January 2001. When it was started? It was started on 1st April 2010. So it was completed on 1st January 2011, means 1st April to 1st January, 9 months, and brought in use on 1st April 2001. But it was brought in use. This building was completed on 1st January 2011 and brought in use on 1st April 2011, right? Brought in use for 1st April 2011. Now the question is, what is the cost of capitalization? What is the cost of capitalization in terms of interest cost? As per Ind AS 23, this loan was taken on 1st April 2010 for 40 lakh rupee. This loan was taken for construction of the building. Okay. So building was completed on 1st January 2011 and brought in use on 1st April 2011. Right. So the demand of the question is, compute the cost of the building which will be included in tangible non-current asset as an addition, means PP&E. Okay. So building was completed in 9 months but brought in use after 12 months. X Limited carried a loan of 40 lakh rupee on 1st April 2010 for construction of the building. The loan carried an interest of 8% per annum and is repayable on 1st April 2012. Okay. Assume that entity did not consider the construction period as substantial period of time as per Ind AS 23. The last line has a twist. The last line has a twist. You know what the last line is talking about? The last line is saying, as per Ind AS 23, the borrowing cost is going to be capitalized. The borrowing cost will form part of the cost of the asset, right? When this borrowing cost is on the qualifying asset. What is meant by qualifying asset? Qualifying asset is an asset which takes substantial period of time for getting ready for intended use or sale, right? And borrowing cost is going to be capitalized. Borrowing cost is to be capitalized on the acquisition, construction, and production of a qualifying asset. Okay. My dear friends, the question itself says that the entity did not consider the construction period as substantial period of time. This 9 month is not considered as substantial period of time. If 9 month is not considered as substantial period of time, whether this interest on borrowing is going to be capitalized, answer is no. See, the question is given you when the building was completed, right? How much loan has been taken? What is the rate of interest? Then it is simple. In the last line, it simply says that it is not considered as a substantial period of time, right? So many students will ignore this fact, and what they do, they made an error. They made a mistake and they will capitalize the interest cost. What they will do, 40 lakh multiply by 40 lakh multiply by 8% multiply by 9 divide by 12. This is what they do, right? Which is wrong. Okay. So friends, we discussed this part and we discussed this and we know this purchase price of land is going to be capitalized, stamp duty is going to be capitalized, architect fee is going to be capitalized, site preparation cost is going to be capitalized. This 2,50,000 of abnormal cost of material is excluded. 22,000 of labor cost is going to be excluded. This general overhead interest cost is going to be excluded, right? Not to be capitalized. This will be the value of the capitalization of property, plant and equipment. Okay. I hope it is clear. Yes. Deferred payment credit, friends, we discussed that in our full course, that the cost of the item of PP, the PP has to be recognized, PP has to be measured on the basis of cash price equivalent at the recognition date, right? If the payment is deferred beyond normal credit terms, if payment is deferred beyond normal credit terms, your PP should be recognized or capitalized at the cash price equivalent, and the difference between consideration paid and the cash price equivalent will be considered as an interest cost. Okay. For example, you went to buy a car. You asked, what is the price of this car? The dealer said 10 lakh rupee. But you said, I will be able to pay you only after 1 year. The dealer said the price is 11 lakh rupee. What does it mean? It means 1 lakh rupee is interest cost. The dealer is funding you. 1 lakh rupee is the interest cost, right? 10% is the interest rate. So cash price equivalent is 10 lakh. Consideration paid is 11 lakh. The difference 1 lakh is interest cost. Okay. Right. Then friend, we discussed exchange of asset. My dear friend, if a PP is acquired in exchange for other non-monetary asset or for a combination of monetary and non-monetary asset, for example, the company has given an intangible asset and the company has acquired a machinery, right? So it is a barter, it is an exchange of asset. Okay. So when you will account for this exchange of asset, right, on the fair value basis. So normally when there is an exchange of asset and the exchange transaction has no commercial substance, for example, you are exchanging the same item. I am exchanging a Maruti Swift car, same make and model, with another Maruti Swift car with the same make and model. So it means this transaction has no any commercial substance, means the risk and the timing of the cash flows will be similar. But for example, if I'm giving a car and taking a machine, so it means there is a commercial transaction, there is a commercial substance to this transaction. So when there is a commercial substance to the transaction, major cost at fair value unless the exchange transaction has no commercial substance, right? So if the transaction has a commercial substance, you have to measure at fair value. You have to measure at fair value. If the transaction major cost at fair value unless the transaction has no commercial substance. If the transaction has no commercial substance, then it has to be at WDV. It has to be WDV. Okay. It has to be WDV. Is that clear, my dear friends? It has to be WDV. Okay. So basically major cost at fair value unless the exchange transaction has no commercial substance or fair value of neither the asset received nor given up can be measured reliably. Friends, in exchange of asset, what you need to do? In exchange of asset, you need to recognize the asset. You need to measure the asset at fair value. But in two circumstances, you have to recognize the asset. You have to measure the asset at cost. What are these two circumstances? When you have to measure the asset at cost, what are those two circumstances? Yes. If the transaction does not have a commercial substance, then asset acquired has to be recorded in the WDV of the asset given up. Number two, if the fair value of neither the asset received while transaction has a commercial substance, but neither fair value of the asset given up is aware, or nor the fair value of the asset acquired can be identified. So ना तो fair value जो asset दे रहे हैं ना तो उसकी fair value पता है, और जो asset ले रहे हैं ना उसकी fair value पता है. So fair value of both the assets is not known. In that case, what you are required to do? In that case, you have to recognize the asset. You have to recognize the asset acquired at the cost of the asset, at the WDV of the asset given up. Okay, at the WDV of the asset given up. Is that clear? Is that clear, my dear friends? I hope it is clear to everyone. Yes or no? Yes. Okay. So now the question is, sir, let's say the transaction is a commercial substance. Now, at what value the asset is going to be recorded? Acquired asset is going to be recorded. Friends, the fair value, the acquired asset is going to be recorded on the basis of below hierarchy. For example, fair value of the asset given up and the fair value of the asset acquired, both are there. Both are there. Okay. So in that case, the first priority has to be given to the fair value of the asset given up. Why? Because it is the consideration which you are paying. It is the consideration which you are paying. Okay. So if fair value of the asset given up or fair value of the asset acquired, both are identified, you have to use fair value of the asset given up. Right. If both the fair values are not identifiable, then WDV of the asset given up. Right. Or if fair value of asset given up is not identifiable, but fair value of asset acquired is identifiable, then of course, whichever is identifiable, then you can use fair value of asset acquired. Right, my dear friends? So we discussed this also. Yes, exchange of asset. We did a case study on exchange of asset. Then, friends, we discussed the measurement subsequent to initial recognition, means at the reporting date. Friends, the company can choose either cost model or revaluation model as its accounting policy, right? Cost model or revaluation model. What is meant by revaluation model? Revaluation model is a fair valuation model. Revaluation model is a fair valuation model, my dear friends. Okay. Revaluation model is a fair valuation model. So major subsequent to the initial recognition, Let me explain you with the help of the Excel file. Initial recognition means recognition at the transaction date. Subsequent to initial recognition means recognition after transaction date, which is at the reporting period. For example, this revaluation model and the cost model, these are the two models. These are the models which are used for the purpose of measurement at subsequent recognition. What is meant by cost model? Means the PP is carried at the original cost. And how you compute the carrying value of the PP? Cost minus accumulated depreciation minus accumulated impairment losses. Original cost is 1 lakh. Useful life is 5 years. Impairment loss at the end of second year is 5,000. Compute the carrying value of PP in case the company has opted for cost model. For example, what is my cost? 1 lakh. What is my remaining life? What is my useful life? 5 years. What is my depreciation for first year? 5. Depreciation for first year is 1 lakh divided by 5. There is no impairment loss in the first year. What is my carrying amount? My carrying amount is cost minus accumulated depreciation minus accumulated impairment losses. Second year depreciation is how much? So my opening WDV divided by remaining life. So now remaining life is 4 year, 80 divided by 4, 20,000, and impairment loss is 5,000. So 55,000 is my carrying amount at the end of the second year. Now, at the end of the second year, my closing WDV is 55,000. At the beginning of the third year, my opening WDV is 55,000. What is the remaining life? 3 years. What is my depreciation for the third year? This divided by 3. Friends, always, for the purpose of depreciation calculation, always use the opening WDV. For example, you have to compute depreciation for financial year 25-26. What is my opening WDV on 1st April 25? Divide by remaining useful life, right? That is the amount of depreciation. Sir, why you are saying that we have to use the opening WDV divided by remaining life? For example, in between, if there is an impairment, right? So if you use the original depreciation, then the number will be incorrect. Then number will get wrong. then number will get wrong. Okay, right, friends? So, friends, this is how I computed my depreciation and carrying amount using the cost model. Using the cost model. Okay, right? Now, what is the revaluation model? Revaluation model means PP has to be carried at fair value, right? And carrying value is equal to revalued amount minus subsequent accumulated depreciation minus subsequent accumulated impairment losses. Why the word is subsequent is used? Because if you revalue the asset, if you recognize the asset at fair value, if you recognize the asset at fair value, the closing balance of the asset will be replaced by the fair value. The closing balance of the asset will be replaced by the fair value. My original cost is 1 lakh rupee. My useful life is 5 years. The company has revalued the PP at the end of second year at 90,000 rupees. Impairment loss at the end of 1 lakh, depreciation 20,000, and this carrying amount is 80,000. What is my depreciation for second year? 20,000. Carrying value at the end of the second year is 60,000. What is my carrying amount at the end of the second year? 60,000. But what is my revalued amount at the end of second year? 90,000. 90,000. So what accounting entry I need to pass? PP account debit to revaluation surplus in OCI. PP account debit to revaluation surplus OCI. Revaluation surplus in OCI account credit. OCI credit, right? 30,000 rupees. Okay. Friends, now what is my carrying value at the end of the second year? 90,000 rupees. What is my depreciation? See, if I'm using a revaluation model, the carrying amount is equal to revalued amount minus subsequent accumulated depreciation minus subsequent accumulated impairment losses, right? Subsequent impairment losses. So what is my depreciation for third year? 30,000 rupees. Okay. 30,000 rupees. What is my impairment loss? Impairment loss is 5,000 rupees. Impairment loss is 5,000 rupees. Okay. What is my carrying value at the end of the third year? 55,000 rupees. 55,000 rupees. Okay. See, you remember I told you always compute depreciation using the opening WDV divide by remaining useful life. Opening WDV divide by remaining useful life. So if I would have used the same amount, so probably I would have end up charging a depreciation 20,000. But every time I am doing a fresh calculation, what is my opening WDV divided by remaining useful life? This has given me the depreciation. This has given me the impairment loss already given in the question. So what is my closing carrying amount at the end of the third year? Revalued amount of 90,000 minus subsequent accumulated depreciation 30,000 minus subsequent impairment loss 5,000. So this is my carrying amount. Now, my carrying value at the end of the third year is 55,000. My remaining useful life is 2 years. What is my depreciation for fourth year? 27,500. This divided by 2. Impairment loss is 0. Nothing is given in the question. This is my 27,500 is my closing carrying amount. Then again, you need to charge a depreciation. At the end of fifth year, it becomes 0. Why revaluation model should be adopted, my dear friends? Tell me. Revaluation model shows the actual picture or fair value of the asset at a particular point in time. At what frequency revaluation is required to be done? If there is major volatility in the prices, do the revaluation on the every reporting date. If there is no major volatility in the prices, do the revaluation at the interval of 3 to 5 years. 3 to 5 years. Okay. The company needs to apply cost model or revaluation model consistently to a class of asset, right? Friends, whatever model the company wants to apply, it has to be applied consistently to a class of asset. What is meant by class of asset? A grouping of assets of a similar nature and use in an entity's operation. For example, office building and factory building. A company has 3 buildings which they are using as their office, corporate office, administrative office. But the company has also 4 buildings which they are using as a factory. So whether these office building or factory building are same class of asset. Let's check this with the help of a definition. A grouping of assets of a similar nature and use in an entity's operation. A grouping of asset of a similar nature and use in an entity's operations. A grouping of asset of a similar nature and use in an entity's operation. So whether this office building and factory building, they have a similar nature and use in an entity's operation. Answer is no. Factory building is used for production. Office building is used for administrative task, right? So office building and factory building are different class of asset. You can use, for example, cost model to office building. You can use revaluation model to factory building. So example of the class of asset could be office building, factory building, vehicle, machinery, furniture and fixture, office equipment, computer, aircraft, land, ships. These are the example. Now coming to the another example. A company has 5 office buildings. Delhi, Mumbai, Jammu, Kanpur, Ludhiana. For Delhi, Mumbai, value is increasing. For Jammu, Kanpur, Ludhiana, value is decreasing. So the company wants to apply revaluation model for Delhi and Mumbai building, but cost model for Jammu, Kanpur, Ludhiana building. Is this treatment right? No. This is not right. The company has to apply a single model, either cost or revaluation to the entire class of a single, entire asset of a single class. Okay, right? A company has 4 buildings. Delhi, Mumbai value is increasing. Jammu, Kanpur value is decreasing. But Delhi, Mumbai building is used for office purpose. Jammu, Kanpur building is used for factory purpose. Company is using revaluation model for Delhi, Mumbai building and the cost model for Jammu, Kanpur building. Is this statement right? Answer is yes. There are 2 class of asset, office building and factory building. On office building, revaluation model is required to be used. In factory building, cost model is required to be used. Not required to be used. So basically in office building they are using revaluation model and in factory building they are using cost model. That is okay. That is okay, right? Why? Because it is different class of asset. Office and factory is a different class of asset. In this case, the company has applied a single model for all the asset of a particular class and hence it is right. And hence it is right. Okay. Now friends, when the company will opt for revaluation model, the company will either having a revaluation gain or revaluation losses, revaluation surplus or revaluation losses. Let's understand the treatment of revaluation surplus and revaluation losses, right? So friends, for example, a building was purchased. Case number 1. The building was purchased on 1st April 2019. 1st April 2019, this building was purchased. Okay. And the purchase, when the building was purchased, the cost was 10 lakh rupee. On 31st March 2020, the value of the building was increased to 12 lakhs rupees. On 31st March 21, the value of the building was decreased to 9 lakh rupee. So 1st April 2019 cost was 10 lakh. It is increased by 2 lakhs. It become 12 lakh on 31st March 20. It is decreased by 3 lakh. It become 9 lakh on 31st March 21. What is the accounting treatment? Let's discuss. The company has opted for revaluation model. First of all, on 1st April 19, what was the entry? Building account debit to bank, 10 lakh rupee. Now on 31st March 20, this value of the building has been increased. You have to debit building. Building account debit 2 lakh rupee to bank. Sorry, to revaluation surplus, not to bank, right? Building account debit to revaluation surplus other comprehensive income 2 lakh rupee. So you will recognize revaluation surplus, you will credit revaluation reserve, and what you will do, you will debit your building. You will debit your building because value of the building has been increased. Okay. Now on 31st March 21, you recorded on 31st March 20, you recorded 2 lakh rupee of revaluation surplus. Now this building value has been decreased by 3 lakh rupee. So what should you do? One thing is very clear. You have to credit building. You have to credit building by 3 lakh rupee. Building को तो credit करना पड़ेगा 3 लाख रुपए से because the closing value of the building become 9 lakh rupee. But what will be debited? Whether impairment loss will be debited for 3 lakh rupee? Answer is no. Standard says that if the company has revaluation surplus balance, if the company has revaluation surplus balance, right, for the particular asset and subsequently there is an impairment loss, the company has to adjust the impairment loss to the extent revaluation surplus is available. So in this case, what I did, revaluation surplus account debit, revaluation surplus OCI account debit by 2 lakh and The remaining amount has been recognized as an impairment loss in the P&L. Impairment loss P&L 1 lakh, right? Clear? Is that clear? Okay. So now another scenario. Case 2. Building was purchased at 10 lakh rupee on 1st April 2019. Building was purchased for 10 lakh rupee, right? On 31st March 20, the value was decreased to 7 lakh rupee. On 31st March 20, the value was increased to 11 lakh rupee. Means in the first year, value was decreased by 3 lakh rupee. In the second year, the value was increased by 4 lakh rupee. What is the accounting treatment? The company has opted for revaluation model. Initially, there is a decrease in the value. So what you do? Impairment loss debited in the P&L. Impairment loss P&L account debit to building PP account 3 lakh. In the next year, the increase is 4 lakh. The building will be increased by 4 lakh. So building account PP debit 4 lakh rupee. 2. What? Whether I should recognize entire 4 lakh rupee as a revaluation surplus. Standard says that if a company has recorded impairment loss on any item of the asset, on any asset, subsequently there is a revaluation surplus, subsequently there is an increase. So first of all, you need to reverse the earlier recorded impairment loss to the extent it is available. So you need to record the increase for the purpose of reversal of impairment loss. So this increase is impacted by reversal of impairment loss, right? So building account debit PPNE, okay, to impairment loss reversal credit 3 lakh rupee, and whatever balance is left to revaluation surplus OCI 1 lakh rupee. Friends, to cut a long story short, when you are opting for a revaluation model and initially you have a revaluation surplus, subsequently you have an impairment loss. So first of all, adjust your loss to the extent of impairment revaluation surplus available. Okay. Vice versa, if you have an impairment loss earlier and then you have a revaluation surplus, so first of all, reverse your impairment loss to the extent it is available to adjust revaluation surplus. Then over and above will go to OCI, right? Okay. What is my utilization of revaluation surplus? Whatever revaluation surplus is available at the time of disposal or derecognition of the asset, right? So this revaluation surplus can be utilized in 2 times. Number 1, at the time of disposal or derecognition of the asset. या तो आप asset को derecognize कर रहे हो, दूसरा during the life of the asset. So when the revaluation surplus is available and the asset is derecognized, the balance of revaluation surplus will transfer to retained earnings. Okay. Accounting entry is revaluation surplus account debit to retained earning account. For example, A Limited has revalued building on which revaluation surplus comes out to 10 lakh rupee. The company has sold the building in the next year. What is the treatment of revaluation surplus on the date of sale? So on the date of sale, what is the treatment? This revaluation surplus will be debited and retained earnings will be credited. Okay. Now, so we discussed about derecognition. Very simple. Now, during the life of the asset, can the revaluation surplus will be utilized? Can the revaluation surplus can be recognized? Can the revaluation surplus can be utilized during the life of the asset? Revaluation surplus can be utilized. Revaluation surplus can be utilized during the life of the asset. The revaluation surplus can be utilized during the life of the asset, right? Every year to the extent of extra depreciation. What is meant by extra depreciation? What is meant by extra depreciation, my dear friends? ये extra depreciation क्या होता है? Example, life of the asset is 10 years. Cost is 1 lakh. Revalued amount is 1,40,000. What is the depreciation on the basis of original amount? Original amount के basis पे depreciation क्या है? 10,000 rupees. The 10,000 rupees the depreciation on the basis of original amount. What is the depreciation on the basis of revalued amount? 14,000 rupees. 14,000 rupees depreciation on the basis of revalued amount using a life of 10 years, right? What is my extra depreciation? 4,000 rupees extra depreciation. What you need to do? Revaluation surplus account debit to retained earning 4,000 every year. This is how in the 10 year, this 40,000 rupees of revaluation surplus will be utilized. Okay. Will be utilized. Is that clear? I hope it is clear to all of you, my dear friends. Great. Yes, great. Now, my dear friends, let's discuss a question on the revaluation surplus in my word file. Question number 5. Just a minute. Yes. Question number 5. Heaven Limited purchased a machinery on 1st April 2001 for 30 lakh rupee, which is reflected in the books at WDV of 17 lakh 50,000 on 1st April 2006. So the cost of the machine was 30 lakh rupee, 1st April 2001. After 5 years, on 1st April 2006, the WDV of the machine was 17 lakh 50,000 rupee. Means 31st March 2, 31st March 3, 31st March 4, 31st March 5, 31st March 6. So there is a depreciation for 5 years. There is a depreciation for 5 years. Okay. The company has estimated an upward revaluation of 10% on 1st April 2006 to arrive at the fair value of the asset. So there is an upward revaluation of how much? Upward revaluation of 10%. So whatever was the value of on 1st April 2006, there was an upward revaluation of what? Upward revaluation of 10%. Okay. Upward revaluation of 10%. Right. Heaven Limited availed the option given by Ind AS of transferring some of the surplus as the asset is used by the entity. Okay. So this company availed the option given by Ind AS, utilization of revaluation surplus during the life of the asset by transferring some of the surplus as asset is used by an entity. So this question is testing your knowledge on revaluation surplus treatment, on the revaluation model treatment, and this question is also testing your knowledge on the utilization of revaluation surplus. On 1st April 2008, means after 2 years, the machine was revalued downward by 15%. Oh, so this question is testing your knowledge on the initial increase, on the upward revaluation, initial increase in the value of the asset and the subsequent decrease in the value of the asset. Okay. Okay. And the utilization of revaluation surplus also. Good question. And the company also re-estimated the machine's remaining life to be 8 years. And the company also re-estimated the machine's remaining life to be 8 years. Okay. So the useful life of the useful life of the machine has also changed. Useful life of the machine has also changed, or probably useful life of the machine has been re-estimated. On 31st March 2010, the machine was sold for 9,35,000. On 31st March 2010, the machine was sold for 9,35,000. The company charges depreciation on straight line method. Oh, this machine was sold also. So whatever revaluation surplus was remaining, again this standard is testing your knowledge on the utilization of revaluation surplus during the life of the asset and at the time of sale of the asset. The company charges depreciation on straight line method. Prepare machine account in the books of Heaven Limited over its useful life to record the above transaction. Friends, first of all, this machine was purchased on 1st April 2001. What was the accounting entry at the time of purchase? Machine account debit to bank account 30 lakh rupee. From 1st April 2001 to 1st April 2006, this value of the machine has become 17.5 lakh from 30 lakh. And the depreciation is on a straight line method basis. Depreciation is on the basis of straight line method. Tell me, if depreciation is SLM, right, and this asset of 30 lakh becomes 17 lakh 50,000 in 5 years, right? So what is the accumulated depreciation in 5 years? 12 lakh 50,000. What is the per annum depreciation? What is the per annum depreciation on this asset? 12,50,000 divided by 5, 2,50,000. Okay. So depreciation on building. Depreciation on building. So depreciation on building is equal to 30 lakh minus 17.5 lakh divided by 5. This is coming at 12.5 lakh divided by 5 is equal to 2.5 lakh per annum. 2.5 lakh per annum. Okay. So first of all, let's prepare the machine account for 1st April 2001 till 1st April 2006. So 1st April 2001, machine account debit to bank account. Depreciation. Depreciation account debit to machine account 2,50,000. This is the closing balance and this will become the opening balance. Every year there is a depreciation. Every year there is a depreciation of 2,50,000, right? Till 31st March 2006. And on 31st March 2006, your closing balance becomes 17,15,000 and your opening balance on 1st April 2006 becomes 17,50,000. 17,50,000. Now, my dear friends, how much is the revaluation surplus? At what value this building this building has been revalued? This building has been revalued using an upward revaluation of 10%. Using the upward revaluation of 10%. So if 17,50,000, if 17,50,000 is the WDV on 1st April 2006 and there is a 10% of upward revaluation, what is my revaluation surplus? What is the accounting entry? Accounting entry is machine account debit to revaluation surplus OCI account. So what accounting entry I'll pass? I'll pass machine account debit to revaluation reserve at the rate of 10%, which is 1.75 lakh. Now, friends, what will be my depreciation? What will be my subsequent depreciation? So on 1st April 2006, my 17,50,000 becomes how much amount? It becomes 17.5 lakh plus 1.75 lakh. It become how much? 17.5 plus 1.75, 19.25, right? 17.5 plus 1, 18.5 plus 0.75, 19.25. Okay. So Heaven Limited availed the option given by Ind AS of transferring some of the surplus as asset is used by the enterprise. Okay. On 1st April 2008, the machine was revalued downward by 15%. Friends, in this question, life is not given in this question. Life is not given in this question. Tell me, if the question has given you that in the 5 year, the total depreciation charge was 12.5 lakh. Okay. And it is charged on a straight line method basis. And residual value is also not given in the question. If per annum depreciation is 2.5 lakh, what is my life of the fixed asset? What is my life of the machine? How can I compute my life of the machine? The cost of the machine 30 lakh divided by per annum depreciation. So my life of machine will come out at 12 years. My life of machine will come out at 12 years. So now every year the depreciation was 2.5 lakh. Now, how much is my carrying opening WDV of the asset? How much is my opening WDV of the asset? My opening WDV of the asset is 19,25,000. Now, how much is my depreciation? So the total life was how much? 12 years. 5 year has already been passed. So the remaining life is 7 year. What is my depreciation? Let's discuss. Let's see the working note. So this working note we have already covered. Remaining useful life is 7 year, right? So depreciation after upward revaluation. Your book value is 17.5, 10% upward revaluation 1.75, revalued amount 19.25, depreciation on revalued amount 19.25 divided by 7, 2,75,000. Friends, 2,75,000 is the subsequent depreciation. What was the original depreciation? 2.5 lakh. What is the extra amount of depreciation? 25,000. So what accounting entry will pass? Depreciation account debit to accumulated depreciation or to machinery 2,75,000. This is your closing balance, right? Then on 1st April 2007, this will become your opening balance and this will become your depreciation. Sir, what is the treatment of revaluation surplus utilization? whether it will not be in the machine account, no. As I told you, na, the revaluation surplus will be debited and retained earning will be credited. It is a balance sheet to balance sheet entry. Revaluation surplus will be debited and the retained earnings will be credited. Okay. So it will be a balance sheet to balance sheet entry. But in the P&L, the full value of the depreciation will go into the P&L. Okay. So friends, so on and so forth. On 1st April 2008, this opening balance comes at 13,75,000 by charging depreciation. Now, question was talking something about on 1st April 2008. The machine was revalued downward by 15%. The machine was revalued downward by 15%. Friends, there is a downward revaluation of 15%. So what is my value on 1st April 2008? My value on 1st April 2008 was 13,75,000. What is my downward revaluation? Let's see downward revaluation value, right? 13,75,000 is my value, opening WDV. Downward revaluation is 15%, which is 15% of 1375, which is 2,06,250. What is my revalued amount? 11,68,750. Now, on 1st April 2006, we have revalued upward. Then on 1st April 2008, it is downward. So it's been 2 years. It's been 2 years when the revaluation was made upward and now it is getting downward. Friends, what was my revaluation surplus at that point of time when I did the upward revaluation? What is my revaluation surplus? My revaluation surplus is how much? 1,75,000. My revaluation surplus is 1,75,000. Okay. 1,75,000 is my revaluation surplus. So how much of revaluation surplus I have utilized? How much revaluation surplus I have utilized? I have utilized a revaluation surplus for 2 years, right? 2 years. And how much I have utilized? To the extent of extra depreciation. You remember in the first 1 to 5 year, the depreciation was 2.5 lakh. Subsequently, it become 2.75 lakh. 25,000 is extra depreciation. So I have already utilized a revaluation surplus of 50,000 rupees. So how much I left with? How much I left with? I left with a revaluation surplus of 1,25,000 rupees. What is my downward revaluation? 2,06,250. So I will adjust out of 2,06,250 of impairment loss. I will adjust 1,25,000 rupees of impairment loss to the revaluation reserve available, and the remaining will be transferred to the P&L account. What will be the accounting entry on this date? The impairment loss is 2,06,250. What will be the accounting entry? Machine will be credit. Machine or what? Building. Let me write to PP. 2,06,250. Then revaluation surplus will be debited by 1,25,000. Then with the remaining amount, impairment loss will be debited by how much amount? 81,250, right? So this will be the accounting entry. Your machine account will be credited and debit will be your 125 revaluation surplus, impairment loss 81,250. This will be the accounting entry. Okay. So you can see on 1st April 2008, your machine has been credited, right? And your revaluation reserve has been debited by 125, P&L has been debited by 81,250, right? Now, what will be my depreciation for this year, my dear friends? On 1st April 2008, in addition to the downward revaluation, there was a re-estimation of the remaining life also, which is 8 years. So now this value of what will be my value? My value after doing a downward revaluation, my value, the revalued amount was 11,68,750. If I'll divide this 11,68,750 by 8 years, it will give me 146,094 as a depreciation. So I'll charge the depreciation of 146,094. So depreciation to machinery. 146,094 is the depreciation. This will be my closing balance and this will be my total, right? And subsequently, what you should do? Subsequently, you should charge depreciation, divide by, so opening balance, right? Divide by remaining useful life. Now something else was given in the question, sir. Oh my God. Additional aspect is also given. On 31st March 2010, the machine was sold for 935. Now, up to 31st March 10, you have to charge the depreciation using 8-year life. So using 8-year life was 1st April 2008 life. Now it is getting reduced year on year. Okay. So on 1st April 2009, this was the opening balance. This is the depreciation. Okay. Now, what is my WDV? What is my WDV? 10,22,656 is my opening balance. 10,22,656 is my opening balance. My depreciation is 146094. So what is my WDV? 6 minus 4 2, 15 minus 9 6, 592, 12 minus 6 6, 11 minus 4 7, right, and 9. So 9,76,000, 9,76,000 or 8,76,000, sorry. 8,76,000 is my WDV. And I have sold it 935. What is the entry? Bank account debit 935 to machine 876,562, 876,562. Okay. Sorry, this will be 6. 876,562. The profit on sale is 58,438. This will be the balancing figure. Friend, this question was the classic example of revaluation surplus, right? This question was the classic example of revaluation surplus. Okay. Then impairment loss, then change in useful life, then utilization of revaluation surplus. Okay. Utilization of revaluation surplus. Okay. So this question was a classic example of all these aspects. Okay. So we discussed question number 5 as well. Question number 5 as well. Yes. Yes. Now, let's go back to the PowerPoint presentation on Ind AS 16. So we discussed measurement, subsequent to initial recognition, cost model, revaluation model. We covered it, right? We covered this part. We covered utilization, revaluation surplus also. Now we have reached to the depreciation. Friends, what is a depreciation? Depreciation is a deterioration in the asset, right? Depreciation is a decrease in the value of the asset due to passage of time, due to the using of the asset. Depreciation. Sir, what is the depreciation? What is the definition of depreciation? Depreciation is a depreciable amount of an asset which is allocated on a systematic basis over the useful life. Depreciation is equal to depreciable amount of an asset which is allocated on a systematic basis over its useful life. Depreciable amount of an asset which has to be allocated on a systematic basis over a useful life. For example, now what is the formula of depreciable amount? The formula of depreciable amount is equal to cost minus residual value or scrap value. Cost minus residual value. Cost minus residual value is the formula of the depreciable amount. For example, the company has purchased a machine. Okay. The company has purchased a machine for 1 lakh rupee. And the company is expecting a residual value of 10,000 rupees. What is my depreciable amount? 1 lakh minus 10,000, 90,000 rupees. The useful life of this machine is 10 years. So now this 90,000 rupee has to be allocated on a systematic basis over the 10 year of the life. Okay. So this 90,000 divided by 10, 9,000 will be the depreciation per annum. At the end of the 10th year, what will be the amount which is left in the machinery account? 1 lakh was the cost. 10,000 is the expected residual value, right? So depreciable amount is 1 lakh minus 10,000, 90,000. And 10 year is a useful life. So over the useful life, I have to allocate this 90,000 rupees on a systematic basis. So 90 divided by 10, 9,000 every year. So in 10 years, I will debit depreciation and credit my machine. by total of 90,000. At the end of 10th year, 10,000 will be available in the machinery account, and you will sell it at a residual, you will sell it as a scrap, you will receive a residual value of 10,000, you will debit bank, credit machinery, right? So depreciation is a depreciable amount of an asset which has to be allocated on a systematic basis over the useful life. Depreciation charges should be recognized as an expense, right? Until and unless it is included in the carrying amount of another asset. For example, a crane. What is a crane? Crane is an PP. Crane is a PP. It's an asset. So a crane is used, a crane is used, a crane is, oh, I hope I am audible. A crane is a PPNE, and this crane is used for the purpose of construction of a building. The cost of the crane is 1 crore. The life of the crane is 10 years. And this crane is used for the purpose of construction of the building for the full year. So what is the depreciation on the crane? 10 lakh rupee. Now whether this depreciation will go to P&L or this depreciation will be capitalized as a part of the cost of the building, cost of the construction of the building. This depreciation on crane will be capitalized as a part of the cost of construction of the building, right? Okay. So depreciation has to be recognized as an expense unless it is included in the carrying amount of another asset. Friends, we discussed the component approach, right? So component approach, what is the meaning of the component approach? So standard says that the PPE has to be depreciated using the component approach. Means if a PPE has a significant component, if a PPE has a significant part, significant component, right? Each major part of a PPE with cost being significant in relation to the total cost of the item should be depreciated separately. If different part have same useful life and depreciation method, such part may be grouped for determining depreciation charge. Friends, two things. For segmenting or segregating the parts of the asset for the purpose of depreciation, the amount has to be significant, the cost has to be significant, the cost should be significant, right? And the cost has to be significant, and the life has to be different useful life, and different useful life. The cost has to be significant and life has to be different, and life has to be different. Okay, and life has to be different. So sir, if the cost is significant but the life is same as of machinery or as of the main asset, then you are not required to componentize and charge depreciation separately. So what is the bottom line? What is the crux of this story? Depreciation has to be provided on the basis of significant component. What is meant by significant component? So depreciation has to be provided separately on the significant component. What is the meaning of significant component? Whose cost is significant and having a different useful life. Okay. So depreciation of an asset begins when it is available for use, not when it is put to use, right? So depreciation of an asset begins when it is available for use, means when it is in location and condition necessary for it to be capable of operating in the manner intended by the management. Okay, right. In the manner intended to be used by the management, depreciation has to be charged till the point it is equivalent to the residual value. Depreciation will be stopped when derecognized or held for sale under Ind AS 105. Depreciation does not stop automatically when an asset is idle. Talking about this example and this example. Friends, a company, or let's say you, Karan has purchased a car, and Karan has purchased a car on 1st April 25 for 10 lakh rupee, and Karan took that car from showroom, and and Karan parked that car in the garage and immediately went to USA, right, for a business trip for the purpose of job. It took around 6 months. Karan was staying in USA for 6 months, and he come back after 6 months, and he has started using the car. So the car was available for use always on 1st April 2025 or 26 when Karan was purchased the car. right? If Karan has used the car after 6 months, right? So that will be the put to use. So depreciation will not start when Karan will started using the car. Depreciation will start when the car was available for use. So depreciation will start when the car was purchased. Okay. Depreciation does not stop automatically when the asset was lying idle. In the COVID time, the factories were stopped, the offices were not working, the assets were not getting used. So it was the offices were working remotely. The production was not happening. Still, the depreciation was going on the plant and machineries. Okay, right? So depreciation should be stopped when the closing WDV will become equivalent to the residual value. Depreciation will be of course stopped when the asset will be derecognized or asset will be classified as held for sale, right? Now, friends, will discuss the method of depreciation, but let's have a break. So it's 8:27 now. Let's have a break and we'll start our session at 8:40. Okay, right? It's 8:28 now. We will start at 8:40. Break start, Ashok ji.
To the method of depreciation, very important. The method of depreciation depends on the future economic benefit. How you will depreciate the asset, right? Be it on a straight line method basis, WDV basis, unit of production basis. So the method of depreciation is depending on the future economic benefit, on the expectation of the future economic benefits, right? For example, there is an asset, there is a machinery, and the life of the machine is 10 years, and the machine will provide the consistent benefit over 10-year period. Consistent benefit over 10-year period, right? So if the machine will provide a consistent and the constant benefit over 10-year period, what is the appropriate method of depreciation? The appropriate method of depreciation is SLM method of depreciation, right? Okay. SLM method you need to apply, and the company will have a constant charge of depreciation in the P&L. There will be equal depreciation in the P&L. Okay. Method depends on future economic benefit, right? Means, for example, this machine, while life is 10 years, but this machine will provide the higher amount of benefit, higher amount of future economic benefit. This machine will provide higher efficiency in the initial year, and then the efficiency subsequently goes down, right? So friends, in this case, if the future economic benefit trend is reducing, then WDV is the right method of depreciation. Means higher depreciation in initial year, then subsequently it goes down. If it is on the basis of usage, the asset provide future economic benefit on the basis of usage. For example, projector. If you go and ask what is the life of the projector from the vendor will say the life is 30,000 lamp hours. He will not say life is 10 year, 5 year, 15 year, 20 year. He will say life is 30,000 lamp hours. 30,000 hours means if in the first year you have used only 5,000 hours, right? So you get a future economic benefit on the basis of only 5,000 hours, right? So unit of production method means you will charge depreciation on the basis of usage, on the basis of units consumed. For example, cost is 1 lakh. The total lamp hour life, the total life is 30,000 hours. So 1 lakh divided by 30,000, multiply by what? Multiply by actual hours consumed, right? So in this case, it is on the basis of usage. It is on the basis of usage, right? So depreciation method, there are three methods of depreciation: straight line method, WDV method, and unit of production method, right? Straight line method gives a constant charge, WDV gives a diminishing charge, and sum of units provide the charge based on the expected outputs, right? So friends, this depreciation method, it reflects the pattern of consumption of future economic benefit. The change in method of depreciation, please remember, the change in method of depreciation, change in useful life, change in residual value, all these are accounting estimates. These are not accounting policy. These are the accounting estimate. The change in depreciation method, change in estimated useful life, change in residual value, these are considered as a change in estimate. It has to be applied prospectively. Whenever there is a change in method of depreciation, change in useful life, change in residual value, it has to be applied prospectively, and your future annual depreciation will be revised. Okay. Talking about retirement and disposals, my dear friends, the carrying amount of a PP shall be derecognized. When? The carrying amount of PP shall be derecognized. When? When it is going to be derecognized? It is going to be derecognized when? When it is actually disposed of. I hope my PPT is visible to everyone. Is it visible or not visible? Yes. So retirement and disposal. So carrying amount of the PP will be derecognized at the time of actual disposal. At the time of actual disposal, right? Carrying amount of PP will be derecognized at the time of disposal. At the time of disposal. Okay. Or when no future economic benefit is expected from the use or the disposal. No future economic benefit is expected. Okay. So friends, whatever amount of gain or loss is there, right? It has to be recorded. It has to be recorded. It has to be recorded in the other income and other expenses. Okay. It should not be recognized as a revenue. If there is a gain, it should not be recognized as a revenue. So these gains and losses will become part of the profit or loss. Okay. right? So let's do a question on this depreciation also quickly. Just a minute. Allow me 5 minutes. Sorry, allow me a minute. I'm just opening that question. Yes. Let's discuss this question number 6. A shipping company is required by law to bring all ships into dry dock every 5 years for a major inspection and overhaul. So this question is talking about a major inspection and overhaul component. Major inspection and overhaul component, okay? Every 5 year, every 5 year for major inspection and overhaul. Overall expenditure might at first sight seem to be a repair to the ships, but it is actually a cost incurred in getting the ship back into a seaworthy condition. Means if this inspection and overhaul will not happen, the ship will not be able to sail. The ship will not be able to sail in the sea. As such, the cost must be capitalized. So this subsequent cost must be capitalized. A ship which costs 20 million with a 20-year life must have major overhaul every 5 years. Cost is 20 million, life is 20 year. The life of the ship is 20 year, the cost is 20 million. Friends, if the cost is 20 million, life is 20 year. So 1 million 1 million depreciation every year, but it says that it must have major overhaul every 5 years. There is a component whose cost is significant, and the life of the component is also different. The entire ship life, is 20 years, but this component life is 5 years only. Component life is 5 years only. Okay. The estimated cost of the overhaul at the 5 year point is 5 million. So what is the value? What is the cost of this major overhaul? The cost of the major overhaul is 5 million. Okay. The estimated cost of the overhaul at the 5 year point is 5 million. Compute depreciation charge for 10-year period. Compute depreciation charge for 10-year period. Friends. Now, what is the depreciation charge for the first 5 years of the asset life? So first of all, what is the total cost? Total cost is 20 million. So overall component, it has a significant cost and it has a significant different life also. So overall component has a 5 million of cost, but ship other than overall component is 15 million. Total is 20 million. Total is 20 million, right? Now talking about the years, this overall cost has to be depreciated over the 5 year period, and this 15 million has to be depreciated over 20-year period. So what is my depreciation per annum for overall component? 1 million, and for other than overall component for the entire ship 0.75 million. So what is my total accumulated depreciation? What is my per annum depreciation? My per annum depreciation is 1.75 million per annum. What is my 5 year depreciation? Total accumulated depreciation for the first 5 year will be 8.75, which is 1.75 multiplied by 5. And the carrying amount of the ship at the end of year 5 will be 11.25, 20 minus 8.75, right? Now assume the actual overcost incurred at the end of year 5 are 6 million. So friends, the overall cost for 5 year point was given. So if it is only 5 million every time, my dear friends, then what should happen? If it is 5 million every time, so you will keep depreciating 5 million over a 5 year. This overall component value will become zero. And new component you will add at 5 million and you will depreciate. and you will depreciate, right? This is what you will do, right? This is what you will do. But my dear friends, but if assuming at the year of end, at the year of at the end of year 5, the actual cost comes at 6 million, then what you will do? So this new amount of 6 million will now be capitalized, okay, to give a carrying amount of 11.75 million. 11.25 the at the end of 5 year, the overall component becomes 0. Now new component will get added, 11.25 plus 6, assuming 6 million is the, assuming 6 million is my, assuming 6 million is my what? Assuming 6 million is my new cost, new overall cost, right? New overall cost. So friends, this cost will become 17.25 million. Now, what is my depreciation charge? My depreciation charge will be, now the overall component cost is 6 million. 5 year is the period. 1.2 is your depreciation on overall component divided by 5 year. And this will be 0.75 only. And now the total will be 1.95. The total will be 1.95. So what is my annual depreciation from year 6 to 10? It is 1.95 multiplied by 5, which is how much? 1.95 multiplied by 5, you can compute. This process will be continue for year 11 to 15 and year 16 to 20 also. By the end of year 20, the capital cost of 20 million will be depreciated, plus the actual over cost incurred at year 5, 10, 15 will also be 0, right? So this overall cost will become 0 in every 5 year, because you are depreciating over a period of 5 years, right? You are taking a different life. Friends, this is what we have covered in India 16. Friends, quickly we'll discuss some MCQs also. A change in depreciation method is a what? A change in policy, estimate, method, standard, what? A change in depreciation method is a change in, depreciation method is a change in accounting estimate. B is the right answer. When an asset is sold or disposed of, when an asset is sold or disposed of, where is the gain or loss recognized? Where is the gain or loss recognized? The gain or loss has to be recognized in asset disposal, P&L, revaluation reserve, depreciation, P&L. The gain or loss has to be recognized in P&L account. Okay. Under Ind AS 16, how often should the useful life of an asset be reviewed? It has to be reviewed at least, once in a year. It has to be reviewed at least once in a year, at least at each financial year end, every 6 months, right? It has to be reviewed at least at each financial year end, right? Okay. Not in 6 months, not at management discretion, never, no. A is the right answer. How should an item of PP be initially recognized in the financial statement? At cost, market value, NRV, fair value? What is the right answer? Of course, at cost. If one large asset has a number of individual components with different useful lives, how should this be depreciated? Component approach. The cost is significant, the life is different. Treat as one asset, break down into different components, expense it all. Treat as one asset but disclose in the notes. No. Break down into different components, okay? Under Ind AS 16, which two subsequent accounting treatments are allowed subsequent to initial recognition? Under Ind AS 16, which two subsequent accounting treatments are allowed subsequent to initial recognition? Cost model, present value model, cost model, revaluation model, fair value, revaluation model, fair value model, and cost model. Yes, B is the right answer. Cost model and revaluation model. When it is dash that the future economic benefit associated with an asset will flow to the entity and the cost can be dash measured, it should be recognized as an asset. What is the right answer? When it is possible that future economic benefit will flow, when it is possible, when it is probable. So possible is not there. This is not there. This is not there. So when it is probable that future economic benefit will flow and the cost can be reasonably measured or reliably measured, reliably measured. C is the right answer. Which of the following is not an asset which falls under the scope of Ind AS 16? Tangible asset? Yes, it falls. Asset held for the production or supply of goods and services? Yes. Asset held for sale in the normal course of the business. It is an inventory. It is not falling in the scope of Ind AS 16, right? Okay. When the revaluation model is used, when the revaluation model is used for PP, the gain or loss should be included in income, gain from revaluation on the income statement, a revaluation surplus account in OCI, an extraordinary gain or loss on the income statement. A revaluation surplus account in OCI, right? C is the right answer. Which of these is an allowable cost of an asset under Ind AS 16? Professional fee, general overheads, initial operating losses, administration expenses. Which of these is an allowable cost? General overhead, no. Initial operating losses, no. Administration, no. Professional fee is the right answer. Right? So friends, thank you so much. Today we have covered in 2 hours, we have covered in detail in day 16. We covered all the concepts from the PPT and Excel file. We covered 5 questions. We covered 5 questions from the Word file. I will share this Word file also. And we also covered MCQs. So even though you guys have read this standard a little bit, so today's revision will help you in understanding this entire standard. But my request to all of you, please, before listening this revision session, because the expectation is you guys have already covered the full course, right? Then you are attending this revision session, right? So my request, if you have not attended the full course, please first listen the full course, attend the full course, right? The videos are available on YouTube. Please get the full course, then come to the revision, right? Because in full course, lot of examples have been taken. The numerical calculation has been shown in the real time, on a real time basis in the class. Okay. So lot of examples, lemon language example have been taken. Lot of questions from board of studies study material has been taken, right? So this Ind AS 16 was covered in 2 classes in the normal full course, right? Whereas this Ind AS 16 is revised in 2 hours. Okay. But still the concept has been completely covered. The questions have been solved, and the MCQ has also been taken, right? So friends, now I am moving to the next standard, which is Ind AS 23 borrowing cost. Sir, why the revision of Ind AS 16 and Ind AS 16 and 23 was clubbed? Because this standard Ind AS 16 and 23, they are complementing each other. This Ind AS 23 is a sub part of Ind AS 16. Let me tell you, Ind AS 23 talks about a borrowing cost capitalization, right? Borrowing cost capitalization where? So largely this borrowing cost will be capitalized in the PP&E, in the tangible asset, right? This borrowing cost is going to be capitalized in a tangible asset. Okay. So if it is a qualifying asset means if it takes a substantial period of time for getting ready for intended use or sale, right? Then this borrowing cost will also become a part of the cost of the PP&E, part of the cost of the asset. Okay. Now, my friends, I am opening my presentation on Ind AS 23. Just a minute. Yes. Friends, we are going to cover now Ind AS 23 borrowing cost standard, right? The name is borrowing cost. Seems like it is a P&L related standard. No. So while borrowing cost will go to the P&L, but here those kind of borrowing costs are discussed where it requires a capitalization. Okay. So friends, borrowing costs which are directly attributable to ACP, acquisition, construction, or production of a qualifying asset is included in the cost of that asset. Borrowing cost which is directly attributable to the acquisition, construction, and production of a qualifying asset will be included in the cost of that asset, right? Other borrowing cost will be recognized as an expense, okay? So talking about the scope, this standard is applicable in accounting for borrowing cost. It does not apply to actual or imputed cost of equity included included preferred capital not classified as a liability. Friends, first of all, this standard, as the word suggests, borrowing cost, the cost of borrowing. So this standard does not capitalize the notional cost. For example, Reliance Power. Reliance Power came with the IPO. I am talking about 2008. So they came with the IPO, and what was the purpose of the IPO? The purpose of the IPO was to develop or install, power stations. Okay. The purpose was to develop PP&E. But the point is, they have raised the equity. So whether the cost of the equity, for example, they were paying the dividend to the shareholders. Okay. So will they capitalize the cost of equity to the cost of the power plant? Answer is no. This equity cost will not be capitalized as a borrowing cost. Okay. Or if there is a preference share capital which is redeemable, then it is a liability. Then the cost of the preference share, redeemable preference share capital, will be added to the cost of the PP&E, or cost of the qualifying asset, right? If it meets the definition of qualifying asset, it has to be capitalized. But if the preference share capital is not classified as a liability, for example, convertible, compulsory convertible preference share, then it will not be classified as a liability, and this will be shown as a this will be shown as a equity only, and that cost of the convertible preference share will not be added to the cost of the qualifying asset. So this standard will not be applicable to borrowing costs related to a qualifying asset measured at fair value, such as biological asset and inventory, which are manufactured or otherwise produced in the large quantity on a repetitive basis. Okay. So friends, we are talking about a borrowing cost, which which is capitalized, which will become part of the cost of the asset when it is related to the acquisition, construction, and production of a qualifying asset, right? So two words are very important in this standard. Number one, what is borrowing cost? Number two, what is qualifying asset? So what is qualifying asset? Let's discuss this first. A qualifying asset is an asset which takes a substantial period of time to get ready for intended use or sale. My dear friends, in our accounting standard 16, AS, I am talking about AS 16. AS 16 also talks about borrowing cost. Ind AS 23 talks about borrowing cost. Friends, when we cover this borrowing cost, so the word substantial period of time, is defined in AS 16, which is 12, which is more than 12 months. But this substantial period of time is not defined in Ind AS 23. Right. So normally people take it as a more than 1 year, but whenever the question comes about a qualifying asset, I would request you, if the question is silent and the construction period is, let's say, so what is the qualifying asset, which takes a substantial period of time to get ready for intended use or sale. So qualifying asset is nothing. It's a work in progress stage of a asset. For example, building under construction is a qualifying asset. A completed building is a property, plant and equipment, is a complete asset. So the question will tell you it will take around 7 months in construction of a building. And the question has given you the loan amount. The question has given you the interest rate. Okay. In that case, please assume that this 7 month will be considered as a substantial period of time, because in the standard substantial period of time is not defined. Number one. Number two, if it is, let's say, 11 months, 9 months, 10 months, like we did a question in Ind AS 16, where it was 9 months, the building was completed in 9 months, but the question says that it is not considered as a substantial period of time. So my dear friends, in that case, if the question itself is saying it is not a qualifying asset, I mean to say this 8 months, 9 months, 10 months will not be considered as a substantial period of time, don't compute and capitalize the borrowing cost as a part of the cost of the asset. Is that clear? ये समझ में आया? अपने आप से आपको दिमाग नहीं लगाना. अगर क्वेश्चन साइलेंट है तो मान लेना कि वो 6 महीने, 8 महीने, 9 महीने, 10 महीने सब्सटेंशियल पीरियड ऑफ टाइम है. और अगर क्वेश्चन कहता नहीं है सब्सटेंशियल पीरियड ऑफ टाइम, तो मान लेना नहीं है. ओके, राइट? सो qualifying asset is an asset, right, which takes a substantial period of time for getting ready for intended use or sale. Following may be a qualifying asset: PP&E, investment property during the construction period. Okay. PP&E during the construction period, investment property during the construction period, intangible asset during the development period, made to order inventories. Made to order inventories means Reliance has given an order. Mr. Mukesh Ambani has gifted an aircraft to his wife Neeta Ambani, and he has given an order to Boeing to manufacture a special aircraft. While Boeing is a manufacturer of aircraft only, right? But here Boeing is manufacturing a special aircraft on the request of Mr. Ambani. So this is considered as a made to order inventory, and if there is a made to order inventory, it will be a qualifying asset. Okay, if it is taking a substantial period of time. So for example, if the Boeing will take 1 year, or let's say 14 months, 15 months for manufacturing this aircraft, and if the Boeing has taken a loan for the purpose of manufacturing the aircraft, so that loan, interest on loan is going to be capitalized as a part of the cost of the aircraft. Now, what is a borrowing cost? Borrowing costs are interest and other cost for borrowing of funds. Borrowing costs are interest and other cost of borrowing of fund. So borrowing cost is an interest cost, first of all, plus other cost, for example, processing fee, right? Plus other expenses. So borrowing cost will include interest expenses calculated using the EIR method. So friends, in under Ind AS 109, you guys have already read effective interest rate method. So this borrowing cost includes effective interest rate method, EIR method. Okay. So this borrowing cost, interest cost has to be computed using the effective interest rate method, using the effective interest rate method. Okay. What is effective interest rate method? For example, you took a loan of 1 crore rupees and rate of interest is 10%. The loan is repayable after 1 year. What is the total repayment? What is the total repayment? 1 crore is the loan amount. Loan amount is 1 crore. Okay. Interest rate. Interest rate is 10%. What is the total repayment? What is the total repayment? Total repayment is 1.1 crore. 1.1 crore is the total repayment. Okay. 1.1 crore is the total repayment. Right. Now, my dear friends, let's say there is a processing fee. There is a processing fee of 5 lakh rupee. Processing fee of 5 lakh rupee. So tell me how much you will receive. How much you will receive the money in your hands. 1 crore rupee you have taken a loan, but 5 lakh rupee have been deducted as a processing fee from your account. So you received 95 lakh rupee and you have to repay. You receive 95 lakh rupee. You receive 95 lakh rupee. Receive 95 lakh rupee, but you need to repay. But you need to repay 1.1 crore rupee. You receive 95, you repay 1.1. So it means how much is the additional repayment? So you get 95, you pay 1.1. So you are paying 15 lakh rupee. This 15 divided by 95. This 15 lakh divided by 95 lakh. What is the amount? 15 divided by 95. Let me do on calculator. 15 divided by 95. This 15.8%, 15.8% is the effective interest rate, right? So 95 lakh minus 95 lakh multiply by 15.8%, whatever will be the interest, you will capitalize in the cost of the, you will capitalize as a cost of borrowing, right? You will capitalize as a cost of the asset. Okay. Interest on lease obligation is per Ind AS 116. Friends, we have already covered Ind AS 116 and we are aware. We have already covered Ind AS 116 and we are aware that under Ind AS 116, right of use asset is going to be capitalized and lease liability is going to be recognized. ROU and lease liability, ROU and lease liability has to be recognized on the 116 accounting treatment. So this lease liability, interest has to be credited on the lease liability. It will increase your lease liability. And when you repay your lease rental, your lease liability will get reduced. So now this borrowing cost also includes interest on lease liability as per Ind AS 116. What is it? For example, a company is constructing a building, okay, and construction of building will take 2 years. The company has taken construction equipment on a lease from the construction equipment supplier company. The company has taken construction equipment on a lease basis. The company has taken construction equipment on a lease basis, right? Now, friends, when the company has taken construction equipment on a lease basis for 2 years, what will happen? For 2 years, what will happen? The company will recognize right of use asset and the company will credit lease liability. ROU debit to lease liability. Okay. So friends, now this lease liability, the company will incur interest also. So this construction equipment was used. This construction equipment was used for the purpose of construction of a building. So now this construction equipment is taken on a lease basis. There is a lease liability, there is an interest on lease liability. So whatever is the interest on lease liability on the construction equipment, it will become part of the cost of construction of the building, right? So this again, this interest cost will also going to be capitalized as a part of the cost of the asset. Exchange difference arise from foreign currency borrowings to the extent that they are regarded as an adjustment to the interest cost. Exchange differences, friends. If I talk about exchange differences, okay, if I talk about exchange differences, so what is it? Exchange differences, okay. For example, the company has taken a loan in the foreign currency borrowing. If the company will take a loan from State Bank of India in India, it will charge almost 8 to 9, 8%, or let's say 10%. The rate of interest 10%. But the company has taken a loan from USA. The company has got this loan at 5%, right? So the company, am I audible and visible? Yeah. I hope my screen is also visible. Ashokji, screen is visible now. Okay, 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 perfect. Yes. So friends, I took a loan from America. I took a loan in the US dollar. It has costed me 5%. But when I took a loan from India, it costed me 10%. It costed me 10%. So while Indian loan is expensive and the foreign loan is cheaper, but tell me, is there any risk associated with the foreign currency loan? Answer is yes. The currency related fluctuation, the forex fluctuation risk is associated with the foreign currency loan. So standard says that when you are taking a foreign currency loan, okay, so you are required to pay an interest on the foreign currency loan, and there will be some exchange difference also on this foreign currency principal amount of the loan, right? So for example, the company has taken a loan of 10 lakh rupee, right? And the company has taken a loan of 10 lakh rupee equivalent to US dollar in the foreign currency. Rate of interest is 5%. So what is my interest cost? 50,000 is my interest cost. Okay. If the company would have taken this loan in Indian currency, this 10 lakh rupee loan, my rate of interest is 10%. What is my interest cost? 1 lakh rupee. In INR, the cost would be 1 lakh rupee. In US dollar, my interest cost comes out at 50,000 rupee. So standard says that the remaining 50,000 rupees, there is a difference of 50,000 rupees. In INR, the amount is 1 lakh. In foreign currency, interest cost is 50,000. Interest cost is 50,000. Okay. 1 lakh and 50,000. So the difference is 50,000. Okay. So if the foreign fluctuation happens, for example, due to Mr. Trump, the dollar was appreciated and rupee got depreciated. So the company has a forex loss of 80,000 rupees on the principal amount of the loan, right? Because the USD becomes expensive and rupee becomes cheaper. So friends, standard says that this exchange difference of 80,000 will will be regarded as an adjustment to the interest cost to the extent of difference between an INR borrowing and the USD borrowing. Means if you would have taken this borrowing in INR, you would have paid 1 lakh rupee. You have taken this borrowing in US dollar, you have paid 50,000 rupees. So what is the difference? Difference is 50,000 rupees. So to this extent of 50,000 rupees, you can capitalize this exchange difference as a part of the borrowing cost, as a part of the cost of the asset. And remaining 30,000 of the forex fluctuation cost will go to P&L, right? So to cut a long story short, what will be your maximum? What will be maximum regarded as an interest cost or cost of the borrowing? Amount equivalent to the INR borrowing, right? Okay. So friends, this is an important aspect. You can expect the question from this aspect also, right? So moving to the recognition, borrowing cost has to be, so all the borrowing costs, right? Capitalized borrowing costs, which are directly attributable to the acquisition, construction or production of a qualifying asset, and borrowing cost will be recognized as a part of the cost of the asset when it is probable that future economic benefit it will be there and cost can be measured reliably. So what is this borrowing cost? It is one of the component of the asset cost only. Okay. Directly attributable means those borrowing costs that would have been avoided if the expenditure on the qualifying asset had not been made. Right. If the expenditure on qualifying asset would not have been made, this borrowing would not have been taken. Okay. And the borrowing cost would not have been incurred. Now, friends, talking about the measurement of the borrowing cost. So there are two type of borrowing. One is specific borrowing, which you have taken for the purpose of construction or acquisition of a particular asset or production of a particular asset. Like you, you buy a home or a flat, and you took a home loan for that flat or that home. So that home loan for that home or the flat is a specific borrowing example. Okay. So if funds are borrowed specifically, then whatever actual cost incurred less any income earned on the temporary investment of such borrowings. For example, on the day one, you took a loan of 1 crore, right, for construction of a building. This building construction will take a time of 1 year. On the day one, you took a loan of 1 crore. So now you will not spend this 1 crore upfront on the day one. It will take some time, right? So you are depositing and this loan is at 10% rate of interest. What is my interest cost? What is my interest cost? 10 lakh rupee. But you are depositing some amount in the fixed deposit, in the short-term fixed deposits, right? For example, sitting on today, you know that in the first month, I need only 15 lakh rupee, 85 lakh rupee I need after 1 month. You deposited 85 lakh rupee for 1 month. So by short term, by temporary investment, you are also earning some income. So standard says that if fund are borrowed specifically, then your borrowing cost, to be capitalized to become part of the cost of asset is interest cost minus income earned on the temporary investment. For example, you earned 1 lakh rupee. So 9 lakh rupee will be considered as a borrowing cost. Okay. So this temporary income has to be reduced. Temporary income has to be reduced. Okay. Is that clear? Is that clear, my dear friends? So moving further, measurement for the general pool of the borrowing. As I told you, a specific borrowing means you are taking a borrowing for the specific asset. But many companies, many groups, you know what they do? They used to procure funds from the alternative sources. There is a treasury department who used to procure funds from the alternative sources. For example, there is a company A Limited. A Limited has issued a 10% debenture for 1 crore, right? And they have procured 1 crore rupee from issuing 10% debenture. They got a 5% term loan. They got a term loan at 5% rate of interest from ICICI Bank for 2 crore rupees. At the rate of 8%, they got a loan from Bank of Maharashtra for 2 crore rupees. So the total funds which they have procured is 5 crore rupees from various sources at the rate of 10%, 5%, 8%. Okay. What is my interest on 1 crore 10%? 10 lakh. 2 crore multiplied by 5%, 10 lakh. 2 crore multiplied by 8%, 16 lakh. What is my total interest? 16 plus 20, 36 lakh. Right. So now, what is my weighted average? What is my weighted average capitalization rate? What is my weighted average cost of borrowing? What is my weighted average cost of borrowing? 36 lakh divided by 5 crore. 36 lakh divided by 500 lakhs. So how much is the cost? Let me do on my calculator. 36 divided by 500 lakhs. 7.2%. My weighted average cost of borrowing is 7.2%. So money has no color. This company has procured 5 crore rupees and deposited in a bank. And now the company is constructing a factory and the company has taken 3 crore rupees from this pool of funds. So now the question is, this 3 crore rupee have been utilized in the cost of construction of a factory. So this 3 crore pertains to what? 10% debenture plus 5% ICICI loan, or 10% debenture plus 8% Bank of Maharashtra loan, or the ICICI and Bank of Maharashtra out of 4 crore, some bit of some amount they have taken, 3 crore rupees they have taken from 4 crore rupees. So in these kind of cases where the company has a general pool, right, and the company is using money from the general pool for the purpose of construction of a qualifying asset, right? So if the funds are part of the general pool, then you need to apply a capitalization rate on the expenditure of the asset. And what is my capitalization rate? Weighted average of the borrowing cost applicable to the general pool. Weighted average cost of borrowing, which is coming out at 7.2% in this case. What is my weighted average borrowing cost? As I told you, total borrowing cost divided by weighted average total of general borrowings, right? So basically total cost of general borrowings divided by total borrowings, total general borrowings. Okay. Like what I did, 36 lakh divided by 5 crore. I did that. Friends, let's come to the Index 23 word file and discuss some questions here. Yes. Discuss some questions here. Okay. An entity constructs a new head office building commencing on 1st September 2001, which continues till 31st December 2001. 1st September to 31st December means how much month? How many months? How much of period? September, October, November, December, 4 months. Directly attributable expenditure at the beginning of the month on this asset are 1 lakh in September and 2.5 lakh in each of the month of October to December. There are some directly attributable expenditure which was happening on this asset, which is 1 lakh rupee on 1st September and 2.5, 2.5, 2.5 respectively in the October, November and December. The entity has not taken any specific borrowing to finance the construction of the asset, but has incurred finance cost on its general borrowing during the construction period. There is no specific borrowing on this asset, but this entity has incurred the finance cost on the general borrowing they have taken. During the year, the entity had issued, 10% debenture with a face value of 20 lakh, 10% debenture with a face value of 20 lakhs, and have an overdraft of 5 lakh rupee, which increased to 7.5 lakh in December 2001. So during the year, the entity had issued 10% debentures for 20 lakh. So debenture is how much? 10% debenture for 20 lakhs. And this company has an overdraft also 5 lakh rupee. So this overdraft was 5 lakh rupee, which increased to 7.5 lakh in December 2001. So entity has a OD facility, OD of 5 lakh rupee, which was increased to 7.5 lakh rupee in the month of December. Okay, in the month of December. In the month of December. Okay. So now interest was paid. Interest was paid on the overdraft at 15% until 1st October. Interest was paid on the overdraft at 15% until 1st October, then the rate was increased to 16%. So means this overdraft was there. This overdraft was there in the month of September also. So this rate of interest was 15% here and 16% here. Okay. Calculate the capitalization rate for computation of borrowing cost in accordance with Ind AS 23 borrowing cost, right? So friends, since the entity has only general borrowing, hence the first step will be to compute the capitalization rate. The capitalization rate of the general borrowing of the entity during the period of construction will be computed as follows. So finance cost, we have 10% debenture on 20 lakhs, right? So what is my finance cost? 10% debenture, 20 lakh rupee on principal amount 20 lakh. Now for the 4 months, what will be my cost for the 4 months? 20 lakh multiply by 10% multiply by 4 divided by 12. 2 lakh divided by 3, 66,667. Now you have to pay. You have to pay interest on bank overdraft also. Interest at the rate of 15%. Overdraft of rupees 5 lakh in September. Why I have used 15%? So friends, this 15% overdraft, is up to 1st October, and this 16% is effective from 1st October. This is up to 1st October. For 1 month, I will compute 5 lakh rupee multiply by 15% multiply by 1 divided by 12. 6,250 rupee. Then for 5 lakh rupee, again 5 lakh multiply by 16%, right? It is at 16%. Multiply by 2 divided by 12. It is coming out at 13,333. Then in the month of December, the rate was increased. The rate was 16% and the overdraft was increased to 7.5 lakh. So 7.5 lakh multiply by 16% multiply by 1 divided by 12, 10,000. So total finance cost is 96,250. What is my total finance cost? 96,250. Okay. 96,250. Friends, what is my weighted average borrowing cost? What is my total finance cost during the construction period? Right? So total finance cost during the construction period is 96,250. 96,250. Okay. So I am computing the total finance cost during the construction period. Divide by what is my weighted average borrowing? What is my weighted average borrowing? So friends, this borrowing is for 4 months, right? And 20 lakh rupee I have used for 4 months. 5 lakh rupee I have used for 3 months. 7.5 lakh I have used for 1 month. So what I do? I will do the weighted. I will multiply the amounts multiply by the weight divide by the total weight. The total months are 4 months. So what I'll do? I have used 20 lakh rupee for 4 months, 20 lakh multiplied by 4, 5 lakh rupee for 3 months, 5 lakh multiplied by 3, 7.5 for 1 month, 7.5 multiplied by 1, divide by the total months, which is 4 months, September, October, November, December. So my total weighted average borrowing is 25,62,500. So 96,250 divided by 25,62,500 is giving me 3.756%, right? Right. This will be my capitalization rate. Friends, now coming back to this. So, sir, if you're capitalizing your borrowing cost to the part of the cost of the asset, right? And the recoverable value of that cost of the asset has been reduced. The recoverable value has gone down. In that case, you have to charge the impairment. So when the carrying amount or the expected ultimate cost of the qualifying asset exceed the recoverable amount or net realizable value, you have to recognize impairment loss of the cost of the borrowing capitalized. You have to recognize the impairment loss. Measurement, right? Commencement of capitalization. Friends, question is, when the borrowing cost should get started capitalization? When the borrowing cost should get capitalized? What is the start date of capitalization? Commencement of capitalization means start date of capitalization. Start date of capitalization. Start date of capitalization. Friends, when I talk about my start date of capitalization, so my question is, for example, a company has taken a loan from State Bank of India for construction of a factory on 1st April 2025. The land was purchased on 1st July 2025, right? And the activity necessary to prepare the asset, means construction activity. The construction activity started on 1st of October. So my question is, the borrowing is taken on 1st April. Land was purchased on 1st July and activity was started on 1st October. So my question to all of you, what is my start date of capitalization of borrowing cost? While my borrowing cost has been started, my interest has already been started from 1st April. But from which date I will start capitalizing my interest cost in the cost of the asset, in the cost of the factory? It will be 1st October 2025 only. You're absolutely right. Friends, while the interest cost from 1st April to 30th September will charge to P&L, and the borrowing cost which is started getting capitalized will be from 1st October 2025. So start capitalizing borrowing cost as part of the cost of qualifying asset on the commencement date. Now, what will be the commencement date? The commencement date for capitalization is the date when entity meets the following condition. When three conditions will meet, the date when which three conditions will meet will known as a capitalization date, will known as a commencement date. What is the three condition? Condition number one, borrowing cost has been incurred, borrowing has been done. अगर borrowing ही नहीं होगी तो आप cost कौन सी capitalize करोगे? Borrowing has been done. Number two, expenditure for the asset is incurred, like land has been purchased. Number three, activity necessary to prepare the asset for its intended use or sale has been started. Sir, if the company, whether this activity necessary to prepare the asset for intended use or sale means the company has to started doing the excavation, right? The company has to started digging on the land. So that will be known as a activity necessary to prepare the asset for intended use or sale. Answer is no. Even though if you have started some technical activity, right? For example, you have started getting a map or architectural design of that factory. So you have started taking all those aspects. You have started doing all those aspects. So even those kind of aspects will also cover under activities which are necessary to prepare the asset for intended use or sale, right? For example, technical and administrative work prior to commencement of physical construction. So physical construction is not always relevant. Even this will also be relevant. Okay. Yes. Let me see the question in the Word file on this aspect. Yes, so I will cover that question, but I will cover that question once I will complete this part. Then I'll cover this question. Okay, let's discuss this question. X Limited is commencing a new construction project which is to be financed by borrowing. The key dates are as follows. 15th May 21, loan interest relating to project started increasing, means borrowing has been done. Borrowing has been done. 2nd June, technical site planning commenced. 19 June, expenditure on the project started increasing. 18 July, construction work commenced. See, the expenditure has been incurred, right? And activity has been started. Okay. So this is the date, 19 June is the date when all these three conditions were simultaneously met. So 19 June is the date of capitalization. 19 June is the commencement date for capitalizing the borrowing cost. Okay. So this physical construction is not only relevant. Okay. So 19 June is the commencement date of capitalization. Suspension of capitalization. My dear friend, what is meant by suspension of capitalization? So we started capitalizing my borrowing cost, right? So the construction work in the factory was going on, and it took around 5 years for constructing a factory, for example. During the time of construction, the labor went on a strike, and due to the labor strike, the construction work was stopped for 5 months. The construction work was stopped for 5 months. Okay. Now the question is, the construction work was stopped for 5 months, right? And this time period is 5 years. The company has taken a loan from State Bank of India for 100 crores. The company has to pay interest for this entire period. But whether the interest relating to this strike period where the construction work was stopped, whether interest relating to this period will continue to be capitalized or capitalization of interest will be suspended. Friends, standard says that capitalization of borrowing cost shall be suspended during the extended period in which it suspends active development of a qualifying asset. Capitalization of borrowing cost shall be suspended during the extended period in which it suspends active development of a qualifying asset. It says that if the active development of a qualifying asset is suspended, then your borrowing cost capitalization shall also be suspended on this extended period. In this 5 month period where the strike was happened, so this borrowing cost capitalization will also be suspended, right? If the qualifying asset active development is suspended. An entity also does not suspend capitalizing borrowing cost when a temporary delay is a necessary part of the process of getting an asset ready for intended use or sale. If the temporary delay is a necessary part of getting the asset ready for intended use or sale, then that temporary delay will not be considered as an extended period of delay, and in that case capitalization of borrowing cost will not be suspended. For example, capitalization continues during the extended period that high water level delay construction of a bridge if such high water level are common during the construction period in the geographical region involved. For example, the government has given you a construction project for constructing a bridge in Cherrapunji. You know that there is a heavy rainfall in Cherrapunji, and you know that out of 1 year, out of a year, you will be able to do the construction work only for 5 to 6 months. In the rainy season, there will be heavy rainfall and the construction work will be stopped. So accordingly, you have factored your budget. Accordingly, you have factored your time budget, cost budget, that if I have to construct a bridge in Delhi, probably it will take 2 months, it will take 2 years. But if I have to construct a bridge in Cherrapunji, it will take 4 years. Okay. So this high rain, this heavy rainfall is part and parcel of getting this construction in Cherrapunji, right? This temporary delay is necessary. This temporary delay is a necessary part of the process of getting that asset ready for intended use or sale. So in that case, we will not defer our capitalization of borrowing cost, will not suspend, not defer, will not suspend. Suspension of capitalization means deferment of capitalization, right? You will defer and you will charge this period interest cost, you will charge to P&L. Cessation of capitalization means stopping the capitalization, my dear friends, stopping the capitalization. So when your asset will be principally completed, when your asset will get completed principally, substantially, when your asset will be constructed substantially, then you have to stop your capitalization of borrowing cost. What does it mean? Sir, have you seen the school where the repair work of the outside wall is going on, or the paint work was going on, but the classes was holding, but the school was keeping classes, right, for teaching the students, for teaching student. So the borrowing cost capitalization will be ceased when substantially all the activity necessary to prepare the qualifying asset for intended use or sale will be completed, right? Okay. So, for example, the paint work is going on, but the school has got the occupancy certificate. The school has got the occupancy certificate. The school has started holding classes, right? So, when the asset will be substantially completed, when the activity necessary to prepare the qualifying asset for intended use or sale is complete, right? Your borrowing cost capitalization will be stopped. Okay. When an entity complete the construction of a qualifying asset in parts and each part is capable of being used while construction continues on other parts, the entity shall cease capitalizing borrowing cost when it completes substantially all the activity necessary to prepare that part for its intended use or sale. Friends, there is a project site. In the project site, one block belongs to residential block, residential. Another one, this company is constructing mall, and the last one is retail complex. While it is one project, but in this entire project there is a residential, there is mall, there is retail complex. So the if the residential portion has been completed substantially, means it is ready for intended use or sale, right? So this residential complex, this residential section is complete while the construction work is going on the mall and the retail complex. So in that case, the interest cost relating to the residential section, residential complex portion, so this interest cost will be stopped for the capitalization, and the interest cost will continue to be capitalized on the mall and the retail complex. Okay. So friends, if interest cost will be stopped for capitalization, then what will be the treatment of the interest cost? It will be charged in the P&L. It will be charged in the P&L. Okay. Is that clear? Yes. What are the disclosures which are required? Amount of borrowing cost capitalized during the period and capitalization rate used, right? What is the rate of capitalization which you have used? You remember, if there is a specific borrowing, simple effective interest rate. If there is a general pool borrowing, you have to use capitalization rate. Okay. Just leave that. Identify borrowing cost, the first step. Identify qualifying asset if it is a qualifying asset. So you remember there are three legs to the borrowing cost: interest cost, interest cost on leases, and the exchange difference, which is regarded as an interest cost. Qualifying asset is an asset which takes substantial period of time for getting ready for intended use or sale, right? If a specific borrowing, calculate actual cost less temporary income. General borrowing, apply weighted average rate. Capitalize borrowing cost to the qualifying asset. Okay. So friends, now let's discuss a question from the study material. From this word file, not study material, from this word file. Question number 6. I hope it is visible to everyone. PQR Limited is engaged in the tourism business in India. The company has planned to construct a holiday resort which is qualifying asset at Shimla. This PQR Limited is engaged in tourism business in India, and they are constructing a hotel. They are constructing a resort which is a qualifying asset, right, at Shimla. The cost of the project has been met out of the borrowed funds of 100 lakh at the rate of 12% per annum. 40 lakh were disbursed on 1st April 2002, and the balance of 60 lakh was disbursed on 1st June 2002. So the cost of the project has been met out of the borrowed funds. And what is the cost of the project? 1 crore. And this 1 crore funding has been taken, loan has been taken. Interest rate is 12% per annum. And out of this 1 crore rupees of loan, 40 lakh was taken on 1st April 2002 and the 60 lakh was taken on 1st June 2002 after 2 months for April and May. The site planning work commenced on 1st June 2002. Borrowing has been started on 1st April 2002, but the planning was commenced on 1st June 2002. Site planning work. Since the chief engineer of the project was on medical leave, the company commenced physical construction on 1st July 2002. Physical construction was started from 1st July and the work of construction continues till 30th September 2002. From 1st July to 30th September, construction work continued. And thereafter, the construction activity stopped due to landslide on the road which leads to construction site. So from 1st July to 30th September, the construction work was going on, but after that it was stopped due to landslide. The road blockages have been cleared and the government machinery by 31st December 2002. It means starting from 1st October, November and December, the active development of the project has been suspended, right? So it is a suspension period, suspended. Construction activity resumed on 1st January 2003 and has completed on 28th February 2003. Then after 3 months of suspension, the construction activity started on 1st January, completed on 28th February. The date of opening has been scheduled for 1st March 2003, but unfortunately the district administration gave permission for opening on 16th March 2003 due to lack of safety measures like fire extinguisher, which had not been installed by then. Determine the amount of borrowing cost to be capitalized towards construction of the resort when landslide is not common in Shimla and delay in approval from district administration office as minor administrative work left over. And the second is landslide is common in Shimla. Everybody knows that landslide will happen. And delay in approval from district administration office is a major administrative work left over. So why in the first case landslide was not common in Shimla and delay from the district administration officer is just because of minor administrative work left over. But here in the second case, it is common in Shimla, but this delay is because of the major administrative pending work. Friends, if I will summarize this, on 1st April 2002, loan was taken, 40 lakh rupee. On 1st June 2002, technical site planning started. The additional disbursement was taken. So friends, this company is constructing a hotel, right? So the company has already purchased the land. The loan was taken on 1st April 2002. While the technical site planning started on 1st June 2002, what is the commencement date? Commencement date is 1st June 2002. This is my commencement date, right? And friends, the interest cost from 1st April 2002 to 31st May, it will be charged to P&L. Now, on 30th September 2002, landslide happened. There was no work between 30th September to 31st December. On 31st December, this landslide was cleared, right? Cleared the landslide impact by government, right? So on 28th February, construction completed, right? And on 16th March, it was inaugurated. Inauguration was started on 16th of March. This is the total schedule. Now, as per Ind AS 23 borrowing cost, the commencement date of capitalization of borrowing cost on qualifying asset is the date when the entity first meet all the following conditions. It incurs expenditure for the asset. It incurs borrowing cost. It undertake activity which are necessary to prepare the asset for the intended use or sale. Then, further, an entity also does not suspend capitalizing borrowing cost when a temporary delay is a necessary part of the process of getting an asset ready for intended use or sale. For example, capitalization continues during the extended period that high water level delays construction of a bridge if such high water levels are common during the construction period in the geographical region involved. An entity shall cease capitalizing borrowing cost when substantially all the activity necessary to prepare the qualifying asset for its intended use or sale are complete. Further, paragraph 23, you are not required to remember the paragraph. Further, paragraph 23 explains that an asset is normally ready for intended use or sale when the physical construction of the asset is complete, even though routine administrative work might still continue. Right? It says that an asset is normally ready for intended use or sale when the physical construction of the asset is complete, while routine small work is going on. If minor modification such as decoration of the property to the purchaser or the user specification are all that are outstanding, which indicate that substantially all the activities are complete. In the given case, since the site planning work started on 1st June 2002, the commencement date of capitalization of borrowing cost will begin from 1st June 2002. This is my commencement date. Right. Then situation number one, when landslide is not common in Shimla, means it is not common in Shimla, means it is not a temporary delay. It is a permanent delay of 3 months. And delay in approval from this administration officer is minor administrative work. In such a situation, suspension of capitalization borrowing cost on construction work will be considered for 3 months, October to December. Your borrowing cost will not be capitalized, it will charge to P&L. And cessation of capitalization borrowing cost will stop at the time of completion of physical activities. Accordingly, the borrowing cost to be capitalized will be effectively for 6 months, 1st June to 30th September, and then 1st January to 28th February. That is total 6 months. The amount of borrowing cost will be 6 lakh rupee, 1 crore multiplied by 6 by 12 multiplied by 12%, because on 1st June 2002 entire 1 crore rupee borrowing has been taken. Now, when landslide is common in Simla but delay in approval from the officer is due to major work left. Since landslide is common in Simla, there shall be no suspension of capitalization of borrowing cost. Further, an asset can be considered to be ready for use only on receipt of approval and after compliance with the regulatory requirements such as fire clearances, etc. These are very important to declare the asset is ready for the scheduled operations. In the given case, obtaining the safety approval is a necessary condition which needs to be complied with strictly, and before obtaining the same, the entity will not be able to use the building. Accordingly, it is appropriate to continue capitalization until the said approval are obtained, because you cannot say that the asset is ready for intended use or sale. Hence, the capitalization of borrowing cost will be for 9 months. That is 1st June till 15th March 2003. Because 16th March the inauguration was happened. The approval for inauguration was taken on was given on 16th of March. 16th of what was the date? 16th of March was the date, na? 16th March, yes. Right. Hence, this capitalization will continue for 9.5 months. And what is the borrowing cost capitalization? 1 crore multiplied by 9.5 divided by 12. Okay. Multiply by 12%. This is principal amount, this is interest rate, this is period. Okay. So friend, this is how we'll do the capitalization. This question number 6 is a very good question to check your knowledge on the commencement date, to check your knowledge on the suspension concept, to check your knowledge on the cessation concept also. In the first case you have seen, in the first case where the approval is just because of minor things. Okay. So we consider this completion up to 28th February. But when there were major things were pending, we consider the completion date as a 16th of March, right? So friends, this is what we have covered in Ind AS 23. My dear friends, so we started with Ind AS 16 and we completed Ind AS 23 also. So in Ind AS 23, we covered the meaning of borrowing cost, the meaning of qualifying asset, the treatment in case there is a specific borrowing. So what is actual cost of the borrowing minus actual cost of the borrowing minus what? Actual cost of the borrowing minus temporary income on such borrowing. If it is a borrowing out of general pool, then you have to compute the capitalization rate, which is weighted average cost divided by weighted average borrowing. Okay. Then friends, you need to commence your capitalization from the commencement date. What is the commencement date? It is a date when 3 conditions will met: borrowing has been taken, expenditure on asset has been done, and the activity necessary to prepare the asset has been started. Borrowing cost will be suspended to be capitalized if in the period where the active development has been suspended. But this suspension period is considered as a temporary period. It is considered as a temporary delay, right? Then on this suspension period, the borrowing cost will not be suspended. Okay. If the activities has been completed substantially for getting the asset ready for intended use or sale, borrowing cost should be stopped. And what is the disclosure? You need to disclose your rate of, you need to disclose your capitalization rate, and you need to disclose your what? The borrowing cost capitalized. So this is about Ind AS 23 and Ind AS 16, which we have covered in detail. I would request all of you, please cover the two classes, the two full classes on Ind AS 16, which I have taken earlier, and one complete class on Ind AS 23, which I have taken earlier, and solve all the questions of the word file and all the questions from the board of studies of ICAI material, study material, right? The more you practice, the more you will become perfect. The more you will become perfect, the more you will score, right? The more you will get marks. Okay. Thank you so much, friends. With this, let me conclude the session. Thank you so much. Bye bye. Take care. Thank you. Ashok ji, session is complete. Thank you. Have a nice day.